Please like, share, and subscribe. Wishing you happiness and good luck every day.
Warren Buffett. You know the name. It's pretty much a synonym for wealth and investing genius. But when you get right down to it, how much do we really know about the guy behind the legend? Let's pull back the curtain and really figure out how this kid from Omaha, Nebraska became one of the most famous investors on the entire planet.
You know, this quote right here, it tells you almost everything you need to know. For Buffett, it was never really about the money itself. You know, the fancy cars, the big houses. It was always about the game. It was a puzzle he loved to solve, and the reward was proving he'd figured it out correctly and, yeah, watching the scoreboard go up.
And that's where you get this really fascinating paradox. On one side, you've got the legend, right? The Oracle of Omaha, this global financial icon. But then there's the reality. He lives in the same house he bought back in 1958. He loves a good hamburger and a Coke. He drives a perfectly normal car. And this isn't some act for the cameras. This is just who he is. It's absolutely authentic.
So yeah, that's the big question, isn't it? How did it happen? I can tell you it wasn't luck. It wasn't like winning the lottery. It was a long journey that started when he was just a little kid, and it was shaped by a few really powerful ideas that he stuck with his entire life.
It all started in his boyhood. I mean, while other kids were outside playing catch, Warren Buffett was completely obsessed with numbers. There's this story about him sitting in church calculating the lifespans of the hymn composers just to pass the time. See, he was wired differently. He didn't just see random numbers, he saw a whole system, a world of patterns. And it didn't take him long to figure out how to make that system work for him.
Just look at this timeline. It's incredible. We're talking about an age when most of us were figuring out how to spend our allowance, and this kid is out there running little businesses. And that visit to the New York Stock Exchange when he was 10? That wasn't just a field trip for him, it was like a pilgrimage to a holy site. And get this, by the time he's 16, he'd already saved over $5,000. In today's money, that is a staggering $50,000. This was way more than a hobby. It was his life's calling, right from the start.
So here it is, his very first taste of the real market. He's just 11 years old. He pulls his own money, even convinces his sister to chip in, and he buys his first stock. Now just try to imagine the sheer terror for a kid when he watches that stock plummet from $38 all the way down to $27. But he held on. He waited. And when it crawled back up to $40, he sold. He made a tiny $5 profit and probably breathed the biggest sigh of relief of his young life.
But then came the lesson, the one he would never, ever forget. Almost right after he sold, the stock didn't just go up a little bit, it exploded. It shot all the way up to $200 a share. He'd been right about the company, but he let his own fear and his own impatience get the best of him. That little $5 he made was nothing compared to the huge gain he'd missed. And that experience seared one crucial lesson into his brain for the rest of his life. Patience is everything.
Okay, so patience was a big piece of the puzzle, but you need more than just patience, right? You need a philosophy, a roadmap. And he found his at Columbia University thanks to a book and a professor who would become the single biggest influence on his life.
You know, reading Ben Graham's book, The Intelligent Investor, was like a lightning bolt for Buffett. It was like everything he kind of felt intuitively about the market was suddenly laid out for him in a clear, logical system. Graham gave him a way to tune out all the noise, all the emotion of Wall Street, and just focus on what really mattered, the business. It just changed everything for him.
And this is the fundamental difference. On one side, you've got what most of Wall Street does, which is speculation. It's a guessing game, right? Trying to figure out what other people are going to do, staring at charts. It's all about the price. But on the other side, you have Graham's idea of value investing. And it's simple. Forget the crowd. Do your homework. Figure out what a company is actually worth. And then just wait. Wait until the market, in all its craziness, offers it to you for less.
And that brings us to the most important concept of all. It's called the margin of safety. Honestly, this is the bedrock. It's not about being a genius who can predict a company's value to the penny. It's simpler. It's about buying a dollar bill for 50 cents. It means buying so cheaply that even if you're a little wrong in your calculations, or if something unexpected happens, you've got this huge cushion built in. It's what separates real investing from just plain gambling.
I just love this quote from Graham because it makes the whole idea click. You don't need to know someone's exact age to know they're an adult. And you don't need a fancy spreadsheet to know a stock is a screaming bargain. You're looking for the obvious ones, the no-brainers, the deals so good you can spot them just by inspection.
All right, so now he's got the philosophy from Graham, he's got his own natural drive. So what's next? He leaves Wall Street, goes back home to Omaha, and he starts putting it all into practice, but this time on his own terms. Now, can you just imagine the sheer confidence it took to do this? He gets his friends and his family to give him their money, and his one rule is basically, look, just trust me. Don't ask what I'm buying, I'll let you know how we did at the end of the year. He needed total control because he knew his system wouldn't work if he had a bunch of nervous investors second-guessing him every time he bought some unpopular stock.
And this is where we see the real genius at work. He finds this old, dying textile mill called Berkshire Hathaway. But he doesn't want the textile business. He sees something else. He sees that even a failing company has cash on its books. And he realized he could use that cash as a sort of piggy bank to go out and buy other, truly wonderful businesses. He basically took the shell of this old company and turned it into one of the greatest investment vehicles in history.
So, over the next few decades, through all the ups and downs of the market, Buffett wasn't just making money. He was taking Graham's ideas and honing them, refining them, into his own clear, repeatable system for winning.
Just listen to this quote for a second. This perfectly captures the absolute insanity of the late 1960s. They called them the go-go years for a reason. It was just a wild party on Wall Street, and the idea was that a stock's actual value didn't matter at all. It was all about hype, all about momentum, the exact opposite of everything Buffett stood for. And Buffett's answer to all that craziness? It was just so simple, so powerful. Price is what you pay. Value is what you get. Price is just a number flickering on a screen, driven by emotion. Value is real. It's the business itself. Speculators are obsessed with price. Investors focus on value. End of story.
And really, his whole blueprint boils down to these key ideas. You know the first two famous ones. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Beyond that, stick to what you know, your circle of competence. Look for businesses with a moat, some kind of deep, durable advantage. Make sure the people running the show are honest. And maybe the hardest part, have the patience to just sit there and do nothing until a fantastic opportunity, the perfect pitch, comes right down the middle.
And this right here, this is the ultimate proof of his discipline. It's 1969. Everybody is making a killing in the market, the party is raging, and what does Warren Buffett do? He sends a letter to his investors and says, the party's over. I can't find anything to buy that's remotely cheap, so we're closing up shop. He literally walked away from easy money because he knew it wasn't safe money. I mean, who does that? And all of this leads us to the final, and I think most profound lesson from his life. It has less to do with finance and spreadsheets and more to do with what goes on inside your own head. This is the big secret, the thing most people miss. Buffett is convinced that being a great investor has very little to do with being the smartest person in the room. It's all about emotional stability. It's about having the right temperament, what he calls firmness of character. It's being able to think for yourself and not get swept up in the crowd's fear or greed. That, more than anything else, is the key. So, when you look back at this incredible life, this journey of compounding not just money, but wisdom, what's the one big lesson we should all walk away with? And there it is. It's so simple, but it's so true. The market isn't a casino. It's not about hot tips. It is, at its very core, a machine. And that machine is designed to systematically take money away from people who can't wait and give it to the people who can. It's all about playing the long game. And I think it's safe to say no one in history has ever played it better than Warren Buffett. Warren Buffett. You hear the name and you just think of money, right? The investing genius, the Oracle of Omaha. But you know, the legend we know today, he wasn't born on Wall Street. The story starts right here, in the heartland, Omaha, Nebraska. So how on earth does a quiet kid who's obsessed with numbers become one of the wealthiest people in history? Well, to really understand the man, you have to go back to the beginning, back to the city and the childhood that made him. I mean, just listen to the way they talked about this place. The Wonder City of the West, a marvel of enterprise. This was not some sleepy, dusty town in the middle of nowhere. Omaha saw itself as a hub, a beacon of progress and ambition. And that's the atmosphere. That's the can-do spirit that a young Warren Buffett would be breathing in from day one. And from his earliest days, it was pretty clear that Warren wasn't quite like the other kids. He had this deep, almost strange fascination with numbers. And he went way beyond just liking math class. This was a true obsession. And just look at the kind of stuff he was counting. We're not talking about a casual hobby here.
This is a kid who would sit on the porch for an entire afternoon just writing down the license plate numbers of every car that went by. Or he'd take a newspaper and count how many times each letter of the alphabet appeared. Get this, during a church sermon, instead of listening, he'd be in the hymnal calculating the lifespans of the composers. It's like his brain was wired to find and catalog patterns in absolutely everything.
So it wasn't long before that obsession with numbers merged with this incredible drive to make money. And these weren't just kids' games. He was running tiny little businesses. He already understood things like location, setting up his lemonade stand where the most people would walk by. He understood arbitrage, buying a six-pack of Coke for $0.25 and then selling each bottle for $0.05. He'd even go to the racetrack and dig through the trash for winning betting tickets that people had thrown away by mistake. For him, everything was a numbers game.
And this right here, this is the moment it all clicks into place. This shows the jump from just counting things to actually analyzing them. At 9 years old, he wasn't collecting bottle caps because they looked cool. He was doing market research. He'd sort them all out to figure out which brand was selling the most, to determine which one was, in his own words, the best business. His mind was already working on a whole different level.
Now, a drive like that doesn't just come out of nowhere. To really get Warren, you have to look at the generations of Buffetts who came before him. This was a family that was absolutely forged in business and ambition. The story really kicks off with this guy, Sidney Buffett. Back in 1867, he was so fed up with his tiny 50-cent-a-day wage that he just packed up and headed west. He landed in Omaha with a chip on his shoulder, and just 2 years later, he opens the very first Buffett grocery store. And from that point on, the Buffett name was a staple in Omaha business, passed down from one generation to the next.
And this quote, this is basically the family motto. It's the core belief that got handed down through the years. Save your credit, for that is better than money. It's not just about making a buck. It's about building a rock-solid reputation for being honest and prudent. The idea that your good name is your most valuable asset, well, that would become absolutely central to Warren's entire philosophy.
So you have all this family history, this legacy of hard work and integrity, and it all comes together in the single most important person in young Warren's life, his father, Howard Buffett, a man of just unshakable moral conviction.
Howard wasn't just a stockbroker. He was his son's moral compass. He gave Warren total, unwavering confidence and taught him, above all, to think for himself. He was also deeply skeptical of paper money, a lesson he learned the hard way during the Great Depression. But Howard didn't just talk the talk. There's a famous story where a client lost money on his advice, and Howard bought the stock back from him with his own money. I mean, that one act tells you everything you need to know about the man's character.
And this was the core lesson Howard drilled into his kids, perfectly captured by this Emerson quote he loved. Keep the independence of solitude. In other words, think for yourself. Don't just follow the crowd. Stick to your own judgment, especially when everyone else is panicking or getting greedy. That single idea will become the bedrock of Warren Buffett's entire investment strategy. And Howard didn't just teach ideals. He opened the door to the real world of finance. When Warren was just 10, his dad took him on this life-changing trip to the New York Stock Exchange. But even before that, back in Omaha, Warren was a fixture at his dad's office, so much so that he was the kid chalking up the stock prices on the big blackboard. So by the time he was 11, he was done watching from the sidelines. He was ready to play. So at just 11 years old, he takes the plunge. He pulls his own money and buys 3 shares of a company called Cities Service for himself. And he gets 3 more for his sister, Doris. The price was $38 a share.
Almost as soon as he buys, the stock tanks, dropping down to $27. Can you imagine the sheer panic for an 11-year-old watching his life savings just evaporate? But he held on, and eventually it clawed its way back up to $40 a share. He sold, locking in his very first profit from the stock market, a grand total of $5. But here's the kicker. This is the lesson that would eventually be worth billions of dollars. Almost the second he sold for that tiny little gain, the stock took off like a rocket, soaring all the way to $200 a share. That $5 profit could have been hundreds, and that one painful experience taught an 11-year-old Warren Buffett the most important lesson of his entire life: patience. So we have this picture of a boy genius, right? He's got this principled, supportive father, and he's on this clear path to success. But that is only half the story. Because if you really want to understand the relentless drive that fueled him, you have to look at the hidden, chaotic side of his childhood, a side that was completely dominated by his mother, Layla.
I mean, this slide really says it all. It was like living in two different worlds under the same roof. On one side, you had Howard, the calm, kind, moral hero of the family, and on the other side, you had his wife, Layla. Now, in public, she was charming, intelligent, the perfect politician's wife. But in private, behind closed doors, she was a source of unpredictable and, frankly, terrifying rages.
And let's be clear, we are not talking about a parent just being strict here. The accounts describe verbal assaults that would go on for hours. She would just degrade her children relentlessly for any mistake they made, whether it was real or something she just imagined. And the worst part was, you never knew when it was coming. A storm could just erupt out of nowhere, and when it did, there was absolutely no escape.
Years and years later, when Layla unleashed a similar 2-hour tirade on Warren's own son over the phone, the boy was just left in tears. Warren found him, and his response was quiet, almost a whisper. All he said was, "Now you know how I felt every day of my life." Just let that sink in for a moment. It speaks to a depth of childhood pain that he almost never talked about.
So how does a kid survive that kind of environment? Well, he developed a strategy. First, he learned to be completely non-confrontational. Never argue, never fight back, just take it. And second, he got out of the house. He spent so much time at his friends' places that one of their moms used to joke that she'd put him out with the cat at night and bring him in with the milk in the morning.
So he had this really complicated home life, combined with his incredible talents, and it was already forging this very self-reliant kid. But then, a huge disruption came along that threatened to take away the one stable thing in his world, his home city of Omaha.
So here's what happened. In 1942, his dad, Howard, pulls off this surprise victory and wins a seat in Congress. For the family, it's a huge deal. But for 12-year-old Warren, it's a disaster. He's torn away from his friends, his little businesses, everything he knows, and he becomes just miserably homesick. So he comes up with this brilliant plan. He fakes a mysterious allergy that supposedly keeps him up all night, and eventually he convinces his worried parents to let him go back home to Omaha.
And he's back in his element. He moves in with his grandfather, Ernest, and starts working at the family grocery store, Buffett & Son. And there, he gets a front-row seat to the family's penny-pinching, no-nonsense work ethic. But while he was hauling crates and sorting through produce, his true passion was calling. He'd spend every spare minute he had tucked away in the back room, just devouring his father's investment books. The store was a decent business, sure, but the stock market, now that was a much more interesting game.
And this really gets to the heart of what drove him. When someone asked him as a young man why he was so obsessed with getting rich, he gave a really telling answer. He said it wasn't about the money itself, not the fancy cars or the big houses. For him, it was about the process. It was the fun of the intellectual puzzle, the joy of making the money, and the deep satisfaction of watching it grow. So it leaves us with the ultimate question, doesn't it? For the Oracle of Omaha, was it ever really about the money, or has it always, right from the very beginning, just been about the game?
When you think of Warren Buffett, you probably picture the Oracle of Omaha, right? The calm, grandfatherly billionaire. But what if I told you that before all that, there was a profoundly unhappy teenager, a small-time hustler, and even a runaway? Yeah, today we're going to pull back the curtain on this little-known story and see exactly how a financial empire was born in the most unlikely of places. It's a heck of a question, isn't it? How does a rebellious kid who feels totally out of place, who literally runs away from home, become the legendary investor we all know today? Well, that journey is full of some incredible twists, and it all kicks off with one moment of pure defiance. All right, so let's set the scene. It's the early 1940s. Warren's father, Howard, gets elected to Congress, so the whole family has to pack up and move from Omaha to a suburb of Washington, D.C. Now, for a 13-year-old kid like Warren, this move was, to put it mildly, a complete disaster. He was just miserable. He'd skipped a grade, so he was already younger than all his classmates. He was this awkward kid with glasses, his grades were pretty meh, and he was known for causing trouble with his teachers. He just felt completely and totally lost. So what's a frustrated kid to do? He runs away, of course. He and a couple of buddies hitched a ride to Hershey, Pennsylvania, of all places, thinking they could get jobs as caddies. But look, this wasn't some grand escape. The very next morning, the police picked them up, asked a few questions, and sent them right back home. It was a pretty half-hearted revolt, but it was enough of a shock to finally get his parents' attention. So his dad lays down the law. He tells Warren, improve your grades or you lose your paper route. Now, for most kids, that might not sound like a huge deal, but for Warren, his paper route was everything. And that ultimatum, it didn't just get him to hit the books, it lit a fire under him that would change everything. And I mean a serious fire. He didn't just keep his route, he turned into a mini empire. Pretty soon, he was delivering 500 newspapers every single morning. He was so clever about it, he even took on a route for the competing paper. That way, if a customer canceled one subscription, as he put it, there was my shining face the next day. Genius. But it was how he did the job that was really amazing. This is where you see the Buffett we know today starting to emerge. He wasn't just a paper boy. He was a logistics expert. For this one massive apartment building, he developed this brilliant assembly line system. He'd drop stacks on different floors to save time, then run through the building. And for collecting the money, he'd just leave envelopes at the front desk. Pure, unadulterated efficiency. And the results? They were absolutely staggering. He was pulling in $175 a month. You have to remember, in the 1940s, that's what a lot of full-time adults were making. As a teenager, he was already out-earning most of his teachers. And you better believe he saved every last penny. This quote from his mother, Layla, man, it says it all, doesn't it? Money wasn't just a hobby for him. It was a dead serious obsession. She said that if he got sick, she would go run the route for him. But she was under strict orders. You do not go near the money drawer. That drawer was sacred ground. And the paper route, that was really just the beginning. Warren's teenage years were basically a masterclass in seeing a business opportunity in absolutely everything. We're talking pinball machines, lost golf balls, you name it. He teamed up with his friend Don Danley and started the Wilson Coin-operated machine company. The partnership was perfect. Buffett was the capitalist. He put up the cash for used pinball machines. Danley was the mechanic. He fixed them when they broke. And Warren, he kept the books and was the front man for the whole operation. And get this, their teenage ingenuity was just off the charts. They were worried because the pinball business was kind of run by the mob back then, so they created this cover story. Whenever a barbershop owner would hassle them for a newer machine, they'd just say, "Sorry, we gotta take it up with the boss." Here are these two kids acting like they're legmen for some tough, mysterious organization. It was a brilliant piece of theater. So what does all of this hustle actually add up to? The paper routes, the pinball machines, reselling golf balls he found, all of it. By the time he graduated from high school, Warren Buffett had personally saved almost $10,000. In today's money, that is well over $100,000. He had built his own small fortune before he was even old enough to vote. But here's the thing. While his business life was absolutely exploding, his social life was, let's just say it was a whole different story. This is where you really see the fascinating, humanizing contrast in the young Warren Buffett. His classmates remembered him as a total oddball. He wore sneakers no matter what the weather was like, even in a foot of snow. He had this clunky change purse attached to his belt and walked with his sort of hunched-over gait. And when it came to girls and school dances, he was completely out of his element. Just, as one friend put it, didn't have the moves. But, and this is the incredible paradox, put that same awkward kid in a corner at a party and ask him about economics or politics, and he would transform. A fraternity brother later recalled how he would just hold court, and suddenly a crowd of 10 or 20 people would be hanging on his every word. He had this amazing natural gift for making really complex ideas seem simple. So at this point, he's got the practical skills down cold. He's got his own capital. He even has this weird charisma when he talks business. But what he was missing was a formal system, an intellectual framework to put around everything he already knew intuitively. And the search for that framework, that's what defined the next chapter of his life. His dad pushed him to go to college, so he ends up at the famous Wharton School of Finance. And he absolutely hated it. He felt like the professors were just teaching theories that had no connection to the real-world nitty-gritty of actually making a profit, something, he'd been doing pretty successfully for years already. After 2 years, he'd had enough. He transferred to the University of Nebraska just to get his degree over with. But his plan was set. The next logical step had to be Harvard Business School, the best in the world. He was so confident, he took the train to Chicago for his interview, thinking it was just a formality. And then, the gut punch. He was rejected. Apparently, the interviewer thought this unpolished 19-year-old kid was just not quite Harvard material. In a letter he wrote to a friend, Buffett tried to play it cool, but you can just feel the sting of that rejection. It was a huge, huge setback. So, now what? His grand plan is in shambles. He's dejected, just flipping through a course catalog for Columbia University, more out of desperation than anything else. And that's when he notices that the authors of a book he'd recently read and absolutely loved were teaching there. The book was called The Intelligent Investor. This quote from his housemate at the time, Truman Wood, just captures the sheer power of this moment. For Buffett, reading that book wasn't just some academic assignment. It was a life-altering revelation. It gave him the logical, intellectual structure for investing that he had been searching for his entire life. The author of that book was a man named Benjamin Graham, the literal father of value investing. Graham's ideas, things like buying stocks for less than they're actually worth and always having a margin of safety, these were the keys that unlocked everything for Buffett. He completely forgot about Harvard. He immediately applied to Columbia for one reason, and one reason only, to study with his newfound god, Ben Graham. And really, that's where the story of the Oracle of Omaha truly begins. It makes you wonder, though, doesn't it? When you look at the world today, you see kids starting e-commerce businesses from their bedrooms or building apps before they can even drive. What seemingly small teenage hustles out there right now are building the foundations for the next generation of giants? You know, when you hear the words greatest investor, one name immediately comes to mind, right? Warren Buffett. He is the standard. He's the icon. But here's the thing. That's not the most interesting question to ask. The real question is, right? Who was the mentor? Who drew the map for the Oracle of Omaha? The answer to that question is the key, not just to understanding Buffett, but to understanding the entire foundation of what we now call value investing. And that answer is a name, Benjamin Graham. He didn't just play the game. He completely changed the rules. And this guy, he wasn't just some investor. He was more like a philosopher of finance, a classical scholar who stared right into the absolute chaos of the market and somehow saw a way to bring order to it. So today, we're going to unpack the story of the man who took stock picking from what was basically a wild gamble and turned it into a disciplined science. So here's how we're going to do it. First, we'll see how a young Warren Buffett stumbled upon Graham's big ideas. Then we'll hit rewind and look at the sheer madness Graham was up against on Wall Street. After that, we'll dig into his core principles, explore his most brilliant parable, watch Buffett put it all to the test, and then we'll see the exact moment the torch was passed. You have to imagine being a young Warren Buffett. The stock market was this just infuriating puzzle. He was trying everything, charting stocks, chasing tips, looking for some kind of secret code. He later said it felt like combing the floor of a racetrack for discarded winning tickets. Just hopeless. And then he finds Benjamin Graham's books. For Buffett, this was nothing short of a conversion. He said it was like Paul on the road to Damascus. All of a sudden, the chaos just made sense. Now, to really get how revolutionary Graham's ideas were, you've got to picture the world he was walking into. Wall Street back then, it had almost nothing to do with analyzing businesses. It was a casino, a frantic, high-stakes game completely driven by rumors, hot tips, and just raw mob psychology. Your success really depended on one thing, guessing what everybody else was about to guess. And this contrast right here, this captures the whole philosophical war of that era. On one side, you've got guys like Gerald Loeb, who are basically saying, look, a stock's real value is a fantasy. You can't know it. So your only move is to bet on what the crowd's going to do. But Graham comes along with this radical alternative. He says, ignore the crowd, focus on the business, and ask a really simple but powerful question that Wall Street seemed to have totally forgotten. What is this business actually worth? This is the trap. This is the exact trap of speculation that Graham saw so clearly. He saw it for what it was, a self-defeating game of psychological chicken, just an endless, circular guessing game with absolutely no solid ground underneath it. So Graham's mission became to build that solid foundation. So you have to wonder, where did this completely different way of thinking come from? Well, it wasn't dreamed up in some ivory tower. It was forged in the fire of intense personal hardship. Graham's whole methodical, risk-averse philosophy was a direct result of financial trauma that almost wiped him out, not once, but twice. The pain really shaped him. First, as a little boy in 1907, he watches his own mother, a widow, get completely wiped out in a market panic. Then, years later, after he's built his own successful fund, he actually navigates the initial 29 crash pretty well. But then, he makes a fatal error. He thinks the worst is over, so he borrows heavily and dives right back in. By 1932, his fund is down 70%. He's nearly ruined. His wife has to go back to work.
That kind of searing experience, it creates an obsession. And his obsession was to build a system that could protect investors not just from the market, but from themselves.
And out of that personal ruin came the first pillar of his entire system, intrinsic value. Here's an easy way to think about it. A house has a market price, right? It goes up and down, but it also has an intrinsic value based on its location, its condition, its size. Graham said every business is exactly the same. It has an underlying worth based on cold hard facts, its assets, its earnings. And that value is your anchor in the storm. It's the objective reality you hold on to when the market's daily price quotes go completely insane.
And that idea leads directly to his most crucial principle, what he called the 3 most important words in investing, in his masterpiece, The Intelligent Investor: margin of safety. The concept is so simple, but it's also incredibly profound. Don't just buy a business at what you think it's worth. No, you wait. You wait until the market offers it to you for far less. That discount, that gap between the real value and the fire sale price, that's your margin of safety. It's your bulletproof vest. It protects you against bad luck, against your own mistakes, and against the madness of the crowd. Now, to really explain this relationship between a rational investor and an emotional market, Graham came up with one of the most brilliant and honestly timeless analogies in the history of finance. He called it the parable of Mr. Market. Okay, so here's how he laid it out. Just imagine your partners in a private business with this, let's call him an emotional guy named Mr. Market. He's not your boss, he's just your partner. And every single day, without fail, Mr. Market knocks on your door and he names a price. At that price, he offers to either buy your share of the business from you or sell you more of his share. The choice is completely yours every single day. But, and here's the catch, your partner, Mr. Market, is a manic depressive. Some days he's on top of the world, totally euphoric, and he quotes a ridiculously high price for the business. But on other days, he's in total despair, and he offers to sell you his shares for pennies on the dollar. His prices have nothing to do with reality. They're driven entirely by his mood swings. And that right there, that is the entire secret. Mr. Market is your servant, not your master. You are totally free to just ignore his silly offers. Or, even better, you can exploit them. When he's terrified and offers you a bargain, you buy. When he's ecstatic and offers you a crazy high price, you sell. You literally turn his emotional instability into your greatest financial advantage. So, that was the theory. Brilliant, right? But did it actually work in the real world? Well, the perfect case study is Warren Buffett's first huge investment. It was a direct application of everything his mentor had just taught him. This was the big test. And his process was pure Graham. Buffett finds out his hero is the chairman of an insurance company called Geico. He doesn't just read a report about it. No, he gets on a train on a Saturday, goes to their headquarters, finds the door locked, and literally bangs on it until a janitor finally lets him in. He then spends the next 4 hours grilling an executive. He does the hard work to find that intrinsic value. And he learns the company is an absolute gold mine. And then, this is the crucial part, he ignores all the so-called experts. You know, the BC and Ds who are all saying it was overpriced, and he plows more than half of his entire net worth into it. And the result of that conviction? He sold his shares the very next year for a 50% profit. A 50% profit. That one investment was the ultimate proof. It showed that Graham's method, ignoring the noise, doing the real work, and always demanding that margin of safety, it wasn't just some dusty old theory. It was a powerful engine for building real wealth. So after working directly for Graham in New York for a couple of years, Buffett decides it's time. Time to go home. He was armed with the philosophy, he had proven beyond a doubt that it worked, and now he was ready to start his own legend by running a brand new investment partnership from a spare bedroom in his house in Omaha. And what a start it was. Just using Graham's methods, Buffett had already turned his personal nest egg of just under $10,000 in 1950 into $140,000 by 1956. That was the year he struck out on his own. The map that Graham had given him was already leading to treasure. But what's really incredible, and kind of funny in hindsight, is that almost no one saw what was coming. At the final meeting of Graham's firm, as it was closing its doors, an investor stood up and gave what has to be the most ironic eulogy in the history of finance. He was complaining that Graham had failed to develop any real talent to succeed him, and he dismissed, quote, this kid named Warren Buffett. Can you believe that? This kid? The world had absolutely no idea what was about to be unleashed. Well, that kid from Omaha would take the map his mentor had drawn, he'd refine it, expand on it, and follow it to become the single most successful investor in human history. Benjamin Graham didn't just teach his students how to find cheap stocks. He gave them a philosophy for thinking rationally in a completely irrational world. And in doing so, he changed the game forever. Okay, picture this. You're 26 years old. You've probably got a few bucks to your name, but what's your biggest money worry? Is it making rent? Paying off a student loan? Well, for a young Warren Buffett, it was something else. He was genuinely, seriously concerned about one day having so much money that it would actually ruin his kids. Now, this wasn't just some kid bragging. This was a man who, long before he had any real wealth, was already wrestling with the problems of a future he saw as an absolute certainty. So, let's dig into that. This is the origin story. We're going to see how a young man's incredibly strange worry was really the product of a self-confidence so powerful it let him build an entire empire completely and totally on his own terms. The year is 1957. We're in Omaha, Nebraska. There's this young guy quietly building this incredible mental map of Wall Street, just soaking up financial data from these old Moody's manuals like a sponge. He's got the brain, for sure. He's got the drive. And he has this absolutely unshakable confidence. But what he doesn't have is a track record. You see, there was this huge gap between what he knew inside and what the world saw on the outside. In his mind, he was going to be rich. There was literally zero doubt. But to everybody else, he was just some kid in Omaha with no real results to his name. And he needed capital to get going. The only thing he really had to sell was that incredible, almost shocking self-assuredness. And just how modest were we talking? Well, at this point, he was managing a grand total of $300,000. And not for some big firm either. This was for a small handful of friends and family. It was a tiny, tiny sum, but it was the seed. And to make it grow, he had to convince some serious people to trust him, not just with the money, but with absolute total control over it. And that brings us to this one crucial moment. He gets a call from a well-known doctor in Omaha, a guy named Edwin Davis. This meeting could give Buffett the cash and, maybe more importantly, the credibility he so desperately needed. This was his shot to get on a bigger stage. But you know what? He wasn't about to change who he was just to get the money. So the doorbell rings, and in walks this guy who, for all the world, looks like a teenager. His hair's got this sort of butch cut, his coat's way too big. He's not trying to impress anyone with his looks. He's there to lay down the law, and he's talking a mile a minute. Let's be honest, not exactly the polished, reassuring money manager you'd expect to hand your life savings over to. He sits down, looks the family right in the eye, and basically says this: "Give me your money, and I will tell you absolutely nothing about what I'm doing with it. You'll get one letter from me a year, that's it. And you can only put money in or take money out on one day, December 31st. No questions, no peeking behind the curtain. These are my rules, take them or leave them." I mean, can you imagine the audacity? It demanded total blind faith in him and him alone. But here's the genius part. His crazy demands were backed up by a brilliantly simple and fair offer. He told them, look, you get the first 4% of any profit, guaranteed. Anything we make above that, we split. And of that extra profit, I take a quarter. The elegance here is that if he didn't perform, if he didn't clear that 4% hurdle, he got paid absolutely nothing. No salary, no management fees, zero. His interests were perfectly, beautifully aligned with theirs. He only won if they won first. So after Buffett leaves, the family is debating. I mean, on paper, it's a wild proposition. But the doctor's wife, Dorothy, she just cuts right through all the noise with a simple gut feeling. She just said, I like everything about this young man. And that intuition, that trust in this quirky, fast-talking kid, that was enough. They wrote him a check for $100,000. The empire had its first real cornerstone. Okay, so the capital is in the bank. The pressure is officially on. Buffett now had to prove that his wild, unconventional methods weren't just talk. He had to turn all that confidence into cold, hard returns for his new partners. His whole strategy came straight from his mentor, the one and only Ben Graham. He called it buying cigar butts. Now, the idea's simple, if a little gross. You're walking down the street and you find a cigar someone's thrown away, but it's got one good puff left in it. You didn't pay a dime for the cigar, so that one puff, it's pure profit. Buffett was looking for obscure, totally forgotten companies that were trading for way less than their assets were actually worth. Companies with one good puff left in them.
A perfect example is Sanborn Map, a company whose main business of making maps was basically dying. The stock was trading at just $45 a share. But Buffett, he digs into the financial statements and sees that the company had this massive investment portfolio built up over all its good years that was worth $65 for every single share. It was a classic cigar butt just sitting there on the sidewalk. So he bought the stock, got himself on the board of directors, and started pushing management to unlock that hidden value for all the shareholders. And the results, they were immediate and they were dramatic. Look at this. In his very first year, 1957, the Dow Jones average dropped over 8%. Buffett's partnerships, they were up over 10%. Or check out 1960. The Dow's down more than 6% and he's up almost 23%. Year after year, he wasn't just beating the market. In the bad years, he was completely defying gravity. And when you zoom out, the cumulative effect is just staggering. After 5 years, if you'd invested in the general market, the Dow, you would have made a very respectable 74%. But if you'd given your money to Buffett, you would have been up 251%. This wasn't just luck. This was a system executed with this relentless, insane focus, and it was producing phenomenal, undeniable results. But listen, raw genius and a great strategy are almost never enough. To get numbers like these, you need a level of concentration that's, well, almost inhuman. And to really understand how Buffett pulled this off, you have to understand the incredible support system that made it all possible. And the most important person in that system was, without a doubt, his wife, Susie. They were the perfect complementary pair. While Warren was completely self-absorbed, living in his own world of numbers and annual reports, Susie was his bridge to the rest of humanity. She handled the bills, the kids, their social life. She even managed his really difficult relationship with his own mother, basically acting as a buffer so he could keep that laser focus. Buffett himself put it best with this simple, really powerful line. His work required a level of concentration most of us can't even imagine, and Susie made that possible by just smoothing out all the rough edges of life, by handling everything that fell outside of his intense little bubble of investing. Her contribution wasn't just helpful, it was absolutely essential. But there was another person who would become just as essential, not as a shield from the world, but as an intellectual sparring partner who could operate on his exact same wavelength. This was, hands down, the most important professional relationship of Buffett's entire life. You know, when Charlie Munger first met Buffett, he didn't ask him for a stock tip. He didn't gush about his track record. He cut right to the chase with this wonderfully blunt question. Warren, what's your racket? That one line tells you everything you need to know about Charlie Munger. He wasn't some disciple. He was an equal, challenging Buffett from the very first minute they met. Munger was brilliant, fiercely independent, and, just like Buffett, incredibly sure of his own analysis. Buffett once said they thought so much alike it was spooky. For a guy like Buffett, who trusted nobody's analysis more than his own, finding an intellectual twin wasn't just helpful, it was a complete game changer. They could finally test ideas and sharpen their thinking in a way no one else could. So, with his capital, his track record, and his support system all locked in, Buffett was about to face a challenge that would test his entire philosophy. It would force him to evolve beyond that simple cigar butt method he'd learned from Ben Graham. Dempster Mill. It was a classic Graham-style investment, a cheap, forgotten company. Buffett bought a controlling stake, betting a full fifth of his entire partnership on it. He even made himself chairman of the board. But there was a huge problem. The business itself was just broken. And Buffett, the master of financial statements, had no clue how to fix the messy, real-world operational details. His passive investing style had just run headfirst into a brick wall. He eventually had to bring in a manager who just ruthlessly cut costs and sold off assets. The investment turned out to be a huge success financially, but the experience hammered home a principle that would become the absolute cornerstone of his philosophy. Never, ever count on making a good sale. The price you pay has to be so attractive that even a mediocre outcome gives you a good result. In other words, the price you pay for something is everything. You know, when you look back from those audacious terms he gave investors to his flat-out refusal to overpay for a business, Buffett's early success was built on a foundation of unshakable principles. He knew his strengths, he defined his own rules, and he never, ever wavered. It kind of makes you wonder, right? In a world that's constantly asking us to bend and compromise, what are the core principles that we're just not willing to give up on?
You know, everyone thinks they know Warren Buffett, the friendly Coca-Cola sipping guy from Omaha. But way before he became this global icon, he was just an investor who found himself in the middle of a crisis that forced him to tear up his own rulebook and find a completely new way forward. This is the story of how Warren Buffett really became the oracle.
Think about that for a second. In the early 60s, this is what he's telling the people who trusted him with their life savings. I cannot promise you results. That's not a sales pitch, right? It's a statement of just profound honesty. He knew the ride wasn't going to be smooth because the biggest opportunities, they're almost always hiding inside the biggest storms, and a huge one was brewing.
So, to really get this transformation, we're going to walk through his journey. We'll start with Buffett as this star pupil, then get into the scandal that just changed everything. We'll see how he discovered a whole new way to think about value, how he taught it to his partners, and finally, we'll take a look at the very complex man who was making all this happen. All right, so let's set the stage. Our story really kicks off with Buffett as this brilliant student of the legendary Benjamin Graham, who was basically the father of value investing. He was playing the game exactly by the book. But even then, you could start to see these little glimmers of the genius he was about to become.
A perfect example is Berkshire Hathaway. Now, in 1962, this thing was a mess, a dying textile company in a dead-end industry. So why on earth would he buy it? Well, because it was what Graham called a cigar butt investment. The stock was selling for about $7.50, but the company's working capital, the hard assets, was worth over $16 a share. It was ugly, sure, but it was dirt cheap. This wasn't some complex strategy. It was just simple, cold arithmetic.
And right here, this is the huge mental leap that Buffett was about to make. See, Graham's world was all numbers, all quantitative. What are the machines worth? What's the inventory worth? It's like a snapshot of a company frozen in time. But Buffett, he was starting to see something more. He was seeing a living, breathing business. He started thinking about the qualitative stuff, things you can't put on a spreadsheet, like how much people love a brand or how loyal the customers are. This was the beginning of a revolution in his mind.
And that revolution, well, it was about to be forged in fire. A crisis that nearly took down one of Wall Street's biggest names and handed Buffett the single greatest opportunity of his career. I'm talking about the Great Salad Oil Scandal.
You have to understand, in the early 1960s, American Express was the future. It was more than just a company. It was this powerful symbol of trust, of a new modern America. I mean, they had $500 million in traveler's checks out there and 1 million cardholders. They seemed completely, totally untouchable.
And then the whole thing just imploded. One of their subsidiaries got caught up in this massive fraud. A company had used Amex warehouse receipts as collateral for loans, but the tanks, supposedly full of valuable salad oil? Yeah, they were mostly full of seawater. The potential losses were gigantic, maybe $150 million. The market completely freaked out. The stock just cratered, losing almost half its value in a couple of months. The word on Wall Street was simple: get out, sell.
But right in the middle of all this chaos, the CEO, a guy named Howard Clark, he says something amazing. He basically announces that even if they aren't legally on the hook for the losses, they feel morally bound to make it right. See, he understood that for a company like American Express, their entire business was built on one thing: trust. Trust was their only real asset. And this was the moment Buffett had been waiting for.
So you've got all of Wall Street sprinting for the fire escape, and what does Warren Buffett do? He puts on his detective hat. He decided he was going to completely ignore the screaming headlines and the plunging stock price and just find out what was actually happening in the real world.
This part of the story is just fantastic. Instead of digging through financial reports, Buffett literally went down to Ross's Steakhouse in Omaha and just watched. He stood by the cashier and watched how people paid. Were they still pulling out their Amex cards? Yep. He went to banks. Were they still selling traveler's checks? You bet. He talked to their competitors. And what he found was incredible. This massive scandal that was on the front page of every newspaper had absolutely zero impact on how real customers were behaving.
And through all this detective work, Buffett discovered something, an asset that just didn't exist in Ben Graham's world of numbers. He called it franchise value. It's this powerful, durable, and basically invisible connection between a company and its customers. It's not a factory, it's not a truck, it's the trust that creates a kind of lock on the market, and you will not find it anywhere on a balance sheet.
And so, he made his move. He didn't just dip a toe in, he went all in. He poured nearly a quarter of all his partnership's money into American Express. This was absolute heresy. Graham taught diversification. He taught safety based on tangible assets. And here's Buffett, betting the entire farm on one single company with a giant question mark hanging over it, all based on an asset he couldn't even measure.
Now, when you make a move that bold, a move that breaks all the old rules, you've got some explaining to do. So Buffett started using his annual letters to his partners to basically teach them, to let them inside his head and explain this whole new worldview he was developing. School was officially in session.
This is how he explained his obsession with compounding. He used this wild example of Queen Isabella funding Columbus's voyage. His point was that spending that 30 grand wasn't just losing 30 grand. No, it was giving up the $2 trillion it could have become. For Buffett, every single dollar was a little soldier you send out to fight for you. And spending it, well, that was like taking it out of the battle forever.
He also loved to take shots at the Wall Street obsession with diversification. He called it the Noah school of investing. You know, you buy 2 of everything. To him, owning hundreds of stocks wasn't a sign that you were being safe, it was a sign that you had no clue which ones were the real winners. For him, diversification was just a way to guarantee you'd get average results.
And guess what? This crazy, unorthodox way of thinking, it worked. I mean, just look at the raw numbers here. Year in, year out, whether the market was up or down, he wasn't just beating the Dow, he was absolutely crushing it. Check out 1966. The market drops over 15%, and his partnership is up more than 20%. The results were just undeniable.
But now, let's zoom out. If you look at the total results over his first decade, the picture gets truly insane. The Dow did okay, up 123%. Not bad. But Buffett's partners? Their money grew by over 1,000%. This wasn't just good investing. This was something else entirely. It was a complete shift in what people thought was even possible.
So, the big question is, who was the man behind these unbelievable numbers? He definitely wasn't some slick Wall Street guy living it up. In fact, the more successful he became, the more you could see this strange paradox at the heart of his personality.
By 1966, when he was just 35 years old, Buffett's own personal stake in his partnership was almost $7 million. In today's money, we're talking way over $60 million. By any definition, he was an incredibly wealthy man.
And yet, this one little story tells you everything you need to know. His wife, Susie, spends $15,000 on furniture for their house, and for Warren, it was agony. His first thought wasn't, wow, the house looks great. It was, do you have any idea how much money that could have turned into? For him, spending money felt like a physical loss.
And this really is the central paradox of Warren Buffett. On the one hand, money meant nothing to him in terms of stuff. He lived in the same modest house for decades, drove a normal car, didn't care about luxury. But on the other hand, money was everything. It was his scorecard. It was the only way he kept track of how well he was playing the game of his life.
And this intense, almost obsessive focus applied to his entire life. He broke with his family's politics, becoming a Democrat because his own analysis led him there. As a father, he cared, but he was often distant, always operating on this internal analytical clock. I think his wife Susie put it best. She said he wasn't really a businessman. He was an artist, and his art was making money. So in the end, this whole period, this great transformation, it showed that Buffett's true genius wasn't just picking stocks. It was about defining his own game on his own terms and creating a way to measure success. For him, the scorecard was money. It was clear, it was objective. It told him if he was winning. Which kind of leaves us all with a pretty big question to think about, doesn't it? What's the scorecard for your life?
All right, let's get right into it. We're about to break down one of the most, well, counterintuitive decisions in the history of finance. It's a story about a guy who, at the absolute peak of his game, when everyone was chanting his name, he just decided to walk away. And that man, of course, was Warren Buffett.
And this is really our starting point. Just try to put yourself in the shoes of one of his investors in 1967. You get a letter from the smartest money manager you know, and this is how it starts. I am out of step with present conditions. What does that even mean? This is the guy who supposedly had it all figured out, and he's basically telling his partners he's lost. This one sentence really gets to the heart of our story today. Why did he feel so completely disconnected from a market that everyone else was falling head over heels in love with?
To really get what was going on in Buffett's head, we've got to set the scene. We're going back to the 1960s. You have to remember, the painful, grim memories of the Great Depression, that was ancient history.
A whole new generation was running the show on Wall Street, and they had absolutely no fear of a crash. This was the go-go era, and believe me, it was a time of wild, almost reckless optimism.
And this really gives you a feel for the vibe back then. The very word speculation, which used to be this dirty word associated with ruin, now felt like a good thing. Everyone was jumping into these new concept stocks, electronics, conglomerates, anything that just sounded like the future. The Dow was knocking on the door of that magic 1,000-point mark for the first time ever, and trading volume, it just exploded, quintupling from 2 million to 10 million shares a day. It seriously felt like the party was never going to end.
But while the rest of Wall Street was putting on their dancing shoes, there was this one guy out in Omaha, Nebraska, who was feeling the exact opposite. As the music of the market got louder and louder, Warren Buffett's internal alarm bells were getting louder too. He was a fundamental investor in a world that had suddenly become full of speculators, and you just knew those two things were on a collision course.
And you can see how this wasn't some sudden panic. It was a slow burn. As early as 1966, he felt like he was drowning in cash, with no sensible places to invest it. So what did he do? He stopped taking on new partners. Then, when the market took a little dip, he refused to sell. He told his partners, look, I'm not in the business of guessing short-term market swings. By 1967, his pipeline of great ideas had slowed to, in his words, a trickle. And all of that led up to that formal, pretty ominous warning we started with.
And this right here, this is the key. This wasn't just him being a stubborn old guy. It was about intellectual honesty. He just refused to play along with what he called fashion investing. He wasn't going to play a game where the rules seemed to be based on hype and momentum instead of actual, logic and value. And as he put it, if he wasn't willing to risk his own money that way, there was no way he was going to risk his partner's money.
So what we've got here is this epic showdown, a fundamental clash of worldviews. In one corner, you've got the new heroes of the go-go years, the so-called gunslingers. And in the other corner, you have the quiet, methodical, patient oracle from Omaha. Now, the gunslinger's weapon of choice, it was this brand new thing called the performance fund. And this was a totally different beast on Wall Street. I mean, forget everything about long-term, patient investing. The only goal here was to beat the market right now, this quarter, this month, heck, even this week. It was all about speed and chasing whatever stock was hot at that exact moment. And if you had to pick one person to be the poster boy for the gunslinger, it was a guy named Fred Carr. He was a rock star. He had the sideburns, he drove a Jaguar, his office was filled with trendy op art. It was all part of the image. And his philosophy was the polar opposite of Buffett's. He said, we fall in love with nothing. Every morning, everything is for sale. And for a while, man, it worked like a charm. His fund returned a mind-blowing 116% in 1967 alone. Now let's jump from that world all the way to Omaha, to Buffett's world, a quiet, frankly boring office. There was no stock ticker flashing prices all day. He didn't want the distraction. Instead of trendy art, he had these huge maroon financial manuals. And on his wall, he kept a newspaper clipping from the 1929 crash. That wasn't for decoration. It was a daily, in-your-face reminder of what happens when speculation gets completely out of control.
So against this backdrop of total market craziness, Buffett's own performance was, ironically, better than it had ever been. But here's the twist. This success didn't make him feel good. Nope. It pushed him toward a decision that absolutely no one on Wall Street could have ever seen coming. Just let this number sink in for a second. 59%. In 1968, a year he found deeply, deeply troubling, Buffett's partnership returned 59%. He didn't just beat the market, he completely crushed it, outperforming the Dow by 50 full percentage points. But he called the result a freak. He knew it wasn't skill in this kind of environment. It was just dumb luck. And he knew that kind of luck doesn't last.
So, here it is, the million-dollar question. You've just had the best year of your entire career. You are the undisputed king. People are literally throwing money at you to invest. The market is screaming upwards. What's your next move? I mean, the obvious answer is you double down, right? You ride that wave for all it's worth.
He quit. He just stopped. In May of 1969, at the absolute peak of his success and the market's frenzy, Warren Buffett wrote a letter and announced he was liquidating his partnership. He was giving all the money back to his investors and walking away from the table. It was an act so against the grain, so contrary to the entire ethos of Wall Street that it was almost impossible to comprehend.
And his reason was just so Buffett. It was simple and it was honest.
I am not attuned to this market environment. It takes an incredible amount of courage and self-awareness to admit, I don't understand the game being played right now. And it takes even more to refuse to play just to keep up appearances. He'd rather protect his record and, more importantly, his partner's money than risk it all in a casino where he didn't like the odds.
And what happened next? Well, this is the stuff of legend. Buffett's completely unthinkable decision was about to be proven right in the most dramatic way you can imagine. The go-go party came to a sudden, screeching, and very painful end.
And, I mean, just look at the carnage. The very same month that Buffett said, "I'm out," the market peaked and then began to completely fall apart. All those story stocks, the high flyers that everyone loved, they basically just evaporated. Litton Industries, a darling conglomerate, lost 70% of its value. And look at National Student Marketing, a stock that went from $140 a share all the way down to $3.50. The great garbage market, as one broker aptly called it, was being hauled off to the dump.
So when the dust finally settled, let's look at the final scorecard, because it really tells the whole story. The gunslingers, they were wiped out. Frederick Mates's fund lost 93% of its value. Fred Carr's famous enterprise fund, it lost more than half of its value from the peak. And Warren Buffett, in his partnership's final year, as the market was absolutely cratering, he still managed to squeeze out a 7% gain, beating the Dow by 18 points on his way out the door. Discipline had completely triumphed over delirium.
So when you look back at this incredible story, what's the big lesson? What's the major takeaway here? Well, it all boils down to a timeless lesson, the absolute foundation of Buffett's entire philosophy. It's a simple distinction that the entire go-go era had managed to completely forget.
And here it is, one of his most famous quotes, and it's never been more relevant than in this story. During that whole crazy time, everyone was focused on one thing: price. Was the price going up? Yes? Then buy. But Buffett was obsessed with something totally different: value. What is this business actually worth? He understood that sooner or later, price always comes back to value. By walking away, he was simply saying that the prices people were paying had become totally unhinged from any reasonable measure of actual value.
So that's exactly what he did. He cashed out, he unlocked the vault, he gave hundreds of millions of dollars back to his partners, and for all intents and purposes, he just walked away from the game of public market investing. A game that he had clearly mastered, but a game whose rules he simply no longer recognized.
But here's the final fascinating twist in the story. He didn't liquidate everything. As he was closing down the partnership, he gave his investors a choice. You can take the cash, or you can take shares in two businesses he controlled. One was a sleepy little insurance company, and the other was a struggling, old-school textile mill in New England called, you guessed it, Berkshire Hathaway. So the question that leaves us with is this: why would a man who just declared that the game was too irrational to play, who walked away from easy money, choose to hang on to a business in a dying industry? And that, my friends, is where the next and even bigger story begins.
You hear the name Berkshire Hathaway, and you probably think of one thing: Warren Buffett. Unimaginable wealth, right? A global powerhouse. But what if I told you that it all started as a failing textile mill? Yeah, a dying business run by the proud, old-school grandson of a sea captain. This is the absolutely wild story of how that old mill got taken over by a young upstart from Omaha and turned into, well, what it is today. So let's get into it. Okay, to really get this story, we have to go back in time. We're in New Bedford, Massachusetts. And this place, I mean, it was literally built on whale oil. As Herman Melville put it, the whole town was harpooned and dragged up hither from the bottom of the sea. All that wealth, all that power came from one single bloody industry. But you have to ask, right? What happens when the whales run out? And that question, that's really the heart of our story. Because the tale of Berkshire Hathaway is really a tale of two different worlds clashing. You've got the old world, a dying industry, proud of its history, desperately just trying to hang on. And then you have the new world, a totally different kind of thinking, cold, rational, a mindset that could look at a pile of rust and see a pile of cash. So let's talk about capital on the move, from whales to textiles. See, when the whaling business collapsed, and it did, almost overnight, thanks to oil being discovered, the smart money in New Bedford didn't sink with the ships. No way. They jumped. They took all that whaling profit and plowed it right into the next big thing: massive cotton mills that were going to clothe a growing America.
And this right here, this is a really core idea for the whole story. It's called capital mobility. Sounds kind of fancy, but it's simple. Money doesn't have feelings. It's not loyal to one industry or one town or one family. Money goes where it can grow. It flows to where the best returns are. The old whalers, they got this. It's a lesson that, ironically, would have to be relearned the hard way in the very textile mills they built. All right, let's meet our first main character. We're at the captain's dyeing mill, and we're talking about the man in charge, Seabury Stanton. He ran Hathaway Manufacturing, and let me tell you, this guy was straight out of central casting for a New England captain of industry. Proud, formal, carrying on the family name, and he had absolutely no idea what was about to hit him. So let's get a picture of this guy, Seabury Stanton. He's the grandson of a whaling captain, so that legacy runs deep. He's a Harvard grad, a World War I vet. Physically, he's this tall, ramrod-straight, very formal kind of guy. And he believed, really believed in the textile business, so much so that he poured $10 million into modernizing his mill while everyone else was letting theirs fall apart. He ran the whole show from what they called his ivory tower, totally focused on keeping that family legacy alive. Now, this is where it gets really interesting. Look at the difference in strategies here. On one side, you have all the other mill owners in town. They saw which way the wind was blowing. They knew textiles in their part of the world were on the way out. So what they ran their old machines till they died, paid out huge dividends to their investors, and took their money to go find something new. But Seabury Stanton, he did the complete opposite. He poured every single penny back into the mill. He was driven by this sense of honor, of tradition. And, it was noble. But it was a disaster waiting to happen. And this quote, this just nails it. It's from one of his own guys. Seabury hadn't the slightest concept of return on investment. Think about that. His only concern was keeping the plant going. He wasn't thinking about making money for the people who owned the company. He was thinking about the building, the machines, the idea of being a textile man. It was all emotion, not logic. And that is a fatal mistake when a young shark starts circling. Okay, so now let's shift gears completely, because while all this is happening in New England, way out in Omaha, Nebraska, a young investor is about to find a bargain. This, of course, is where Warren Buffett enters the story. And his way of looking at a business couldn't be more different from Stanton's. He didn't care about tradition or legacy. He cared about one thing: the numbers on the page. So check this out. Late 1962, a single share of Berkshire Hathaway stock would cost you $8 1/8, just over $8. Think about that. The company was a mess. It was losing money hand over fist. The whole industry was going down the drain. Wall Street wanted nothing to do with it. To any sane person, this company looked like toast. But Buffett saw something nobody else did. He looked past the stock price and dug into the balance sheet. And he found this number, $16.50. That was the company's working capital per share. Basically, if you sold off all the easy-to-sell stuff and paid off all the short-term debts, you'd have $16.50 left over for every share that was selling for only $8. It was insane. The company was literally worth more broken up and sold for parts than it was as a living, breathing business. This is what's called a cigar butt investment. It's like finding a used cigar on the ground that has one last free puff in it.
So what do you think Buffett did? He started buying and buying and buying, just quietly snapping up shares. And the craziest part? He did all of this without ever stepping foot in the factory. He didn't need to smell the cotton or talk to the guys on the floor. For him, the whole story was right there in the financial statements. And just like that, by 1963, his investment partnership was the biggest single shareholder in a company he'd never even seen with his own eyes.
And here we go. This is the moment everything changes. A takeover over ice cream. This is the ultimate clash of two worlds. You've got Stanton, the old guard, in his ivory tower in Massachusetts, and you've got Buffett, the new blood, the numbers guy from the Midwest. A collision was bound to happen. And the wild thing is, the final battle wasn't some big, dramatic boardroom fight. It was something much, much stranger. So let's just walk through how this all went down. In '62, Buffett starts buying up the cheap stock. By '63, he's the biggest owner. Now here's the twist. In '64, he actually makes a deal to sell his shares back to Stanton. He's ready to take his profit and walk away. But at the last second, Stanton tries to screw him over on the price by just a few cents a share. We're talking 3/8 of a point. It was nothing. But Buffett was furious. He felt like he'd been cheated, and he got so angry that he didn't just back out of the deal. He decided to buy the entire company out of spite. That tiny, petty move by Stanton sealed his own doom. A year later, in May '65, Stanton's out and Buffett's in control.
So before the takeover, Buffett finally decides to go visit this mill he's been buying. Stanton and the other top brass are too busy, so they send this middle manager, a guy named Ken Chase, to show him around. Chase is a straight shooter, no ego, and he just tells Buffett the truth about all the company's problems. For 2 days, Buffett just listens and asks questions. And as he's about to leave, he turns to Chase and says, "I'll be in touch with you, Ken." Boom. In that moment, Buffett knew. He'd found the guy who was going to run this whole operation for him.
All right, so here it is, the birth of the Berkshire Hathaway we know today. Stanton is gone, Buffett is in charge. He makes good on his word and puts Ken Chase in the president's chair. And then he introduces a whole new way of thinking about business, a philosophy that was so different, so foreign to these old textile guys that it must have felt like it came from another planet.
Right away, Buffett sits down with Ken Chase and lays out the new law. And this quote, this is everything. He says, "I'd rather have a $10 million business making 15% than a $100 million business making 5%. Why? Because I have other places I can put the money." See, for him, it wasn't about being the biggest. It was about being the most profitable for every dollar you put in. If your money isn't working hard for you in one place, you take it out and you put it somewhere it will. That was the whole game.
And this basically became his playbook. 4 simple rules. Rule 1. Starve the bad business. No more pouring money into the textile mill. Cut it off. Rule 2. Harvest the cash. Any profit the mill does make, you don't reinvest it, you pull it out. Rule 3. Find good businesses. Take that cash and go buy completely different companies in other industries that actually make great money. And the final step, Rule 4. Trust great managers. You buy a good company, you love the smart people who are already running it, keep running it. It sounds so simple now, but back then, absolutely revolutionary.
So his first big move with this new cash was brilliant. He bought an insurance company back in Omaha. Now, why insurance? Because of this magic thing called float. Think about it. You pay your insurance premium today, right? But you might not have a claim for years or ever. The insurance company gets to hold on to your money and millions of other people's money in the meantime. That giant pile of cash they're holding is the float, and they can invest it and make a profit on it. Buffett realized an insurance company wasn't just a company, it was a money-generating machine for his investments. And you want to see if the plan worked? Just look at this. 5 years later, 1970. The original textile business, the thing Stanton poured his heart and soul into, made a measly $45,000. Okay. Meanwhile, the new businesses, insurance and banking, they brought in over $4.5 million. The difference is it's staggering. The old mill was barely breaking even, while the new companies were gushing cash. It was proof that the strategy was an absolute home run.
But the story doesn't end there, because now we get to the final twist, a kind of Faustian pact. You've got the most logical, rational investor on the planet, the guy whose whole philosophy is to get money out of bad businesses. So what does he do? He does something that makes no sense on paper. He keeps the textile mill. So why? Why would he do that? Well, it turns out even Warren Buffett isn't a robot. The reasons were, well, they were human. For one, he didn't want the reputation of being a liquidator, some corporate raider who just comes in, fires everyone, and sells the scraps. He also felt a real debt to Ken Chase, the guy he'd put in charge. And strangely enough, he actually kind of liked the old factory. He respected the work ethic there. So he made a deal with himself. As long as the mill didn't actively lose money, he'd let it live, even if it wasn't making much. And so, the textile business was basically put on life support. It was bled to the bone. Every spare dollar was siphoned off to buy other, better companies. But Buffett let it keep going. For another 20 years, the looms on Cove Street kept on humming. The original business became a ghost, haunting the new empire that still carried its name. And that's what this whole incredible story leaves us with, right? It's a huge question. Berkshire Hathaway is maybe the greatest success story in modern business. But it's also the story of a painful death, the death of a company, an industry, a whole way of life. And it just makes you wonder, when is it the right call to let a cherished legacy die so that something new can be born? Where do you draw that line between honoring the past and fighting for the future? It's a tough one, and it's something we all have to think about. You ever wonder what really separates a good investor from a legendary one? You know, sometimes it's not about just staying in the game forever. It's about knowing that one perfect moment to come roaring back. Well, this is the story of how one of the greatest investors of all time found his purpose again, right in the middle of a national crisis. And in doing so, he stumbled upon the opportunity of a lifetime. Okay, picture this. It's October 1974. The stock market is in an absolute total freefall. The Dow Jones is sitting at a brutal 580. The headlines are all screaming about recession, inflation. The national mood is just complete despair. And right in the middle of all this financial carnage, one man tells a major magazine, now is the time to get rich. And who says this? None other than Warren Buffett. So you have to ask yourself, how in the world did he find this incredible confidence when literally everyone else was running for the hills? To really get what was going on in his head in '74, we have to rewind the clock. Because just 4 years before that, Warren Buffett, the investing prodigy, he'd walked away. He quit. He was done. So this wasn't a comeback story yet. No, this was the story of a guy who had already won the game and had no idea what to do next. So it's 1970, Buffett's turning 40. He has already made a fortune, a staggering $25 million back then, by closing down his famous investment partnership. In Omaha, he's a big deal for sure, but he doesn't have a full-time job anymore. He's kind of in this state of limbo. He's watching over a few investments, but mostly he's just adrift. He even told one aspiring money manager flat out, I am no longer in the investment management business. Like he was gone for good. And this quote from his good friend, the journalist Carol Loomis, just nails his internal conflict. Buffett felt it was time for, other goals. He had all this money, so what was the point of just making more? He was actually thinking seriously about public service. He was getting friendly with politicians, and he was really searching for a new purpose that went beyond just watching the stock ticker. So he starts trying to use that incredible brain of his in the world of social good. He gets into liberal politics a bit, supports some Black-owned businesses, and gets involved in philanthropy. But the search for a brand new purpose, well, it hits a wall. And for a man like Buffett, it was a very specific and really frustrating kind of wall. Just look at these two worlds, right? His mind was built for the one on the right, investing. It's a world of hard data, strict discipline, and crystal clear, measurable results. You know if you won or if you lost. But philanthropy, social causes, that was the world on the left. It mostly runs on faith and good intentions, and the results, they were incredibly hard to measure. He got involved with things like the Community Bank of Nebraska, but when it started failing from bad loans exactly like he warned it would, he kept his wallet shut. For him, throwing good money after bad, even for a noble cause, it just violated every principle he lived by. And you don't have to take my word for it. Buffett himself put it best. This right here is the key to his frustration. He needed a yardstick. He needed a scorecard. Without a clear way to measure success or failure, to know if his capital was being put to its absolute best use, he felt totally lost. The very discipline that made him a genius investor made him a pretty uncomfortable philanthropist. And this is where the story takes a fascinating turn, because the solution to his whole crisis of purpose, it comes from a place he never expected. Not from a stock chart, but from a piece of investigative journalism at this small weekly newspaper he owned, the Omaha Sun. And this story, it would not only win a Pulitzer Prize, but it would completely reignite his passion for business and for investing. So here's how it went down. Buffett gets a tip about Boys Town, this famous Omaha institution for troubled kids. He passes it along to his newspaper, and what they uncover is just incredible. While this charity is sending out these heart-wrenching mailers pleading poverty, they're secretly sitting on an investment portfolio of $162 million. That's twice the endowment of the University of Notre Dame. For Buffett, who saw capital as almost sacred, this was just a cardinal sin. Wasting it, misdirecting it, it was unforgivable. The story was a huge win for journalism, but for Buffett, it was a much deeper, much more personal business lesson. You see, his newspaper, The Sun, was the weak number 2 in town. Whenever it raised its ad rates, circulation would drop. But the big dog, the Omaha World-Herald, that was a totally different animal. And Buffett realized it was like owning the only bridge into town. If you're a department store and you need to advertise, you have to use that paper. You have no choice. You have to pay the toll. It was a protected, durable franchise. And right there, he had stumbled upon the blueprint for the perfect business. And right as Buffett is having this massive epiphany about what makes a truly great, powerful business, Wall Street is heading in the exact opposite direction. The market, which had been flying high for years, was about to completely lose its mind. See, back then, everybody on Wall Street was obsessed with this group of stocks they called the Nifty 50. These were the big, famous growth companies, Xerox, Kodak,
Polaroid. The theory was that these companies were so good they would grow forever, so they were safe at any price. Fund managers just piled into them, pushing their prices up to these astronomical levels. And you can see exactly what happened next right here. In '72, it was pure euphoria. These stocks were trading at 80 times earnings, sometimes more. Then, in 1973, the market cracks. The safe stocks start to fall, and boom, panic selling kicks in. By 1974, it's not even panic anymore, it's just total abject despair. Wall Street had gone from mindless imitation on the way up to mindless imitation on the way down. The headlines from that time, man, they really paint a picture of the mood. This wasn't just a little dip or a minor correction, it was a sickening slide. The media was just capturing the sheer terror that was gripping the entire financial world. And it just kept coming. Forbes asked, why buy stocks? Fortune magazine ran with a case for gloom about stocks. It seemed like every single financial publication was confirming what investors were feeling in their gut, that the sky was falling and there was absolutely zero reason to own a single share of stock. But while the rest of the world was absolutely consumed by fear, Buffett, now armed with his toll bridge philosophy and a brand new sense of purpose, was having a completely different reaction. What everyone else saw as a catastrophe, he saw as the single greatest opportunity he had ever seen in his life. I mean, can you imagine that? While professional money managers were paralyzed with fear, Buffett was telling his friends he felt like tap dancing to work. He was in a state of pure ecstasy. All those ideas and that desire that had kind of drained away in the late 60s were now flooding back with the sinking market. He was running like a colt, just grabbing bargains left and right for Berkshire Hathaway's portfolio. And this is a perfect example of the kind of deals he was seeing. Take the Washington Post Company. Wall Street was valuing the entire company, its dominant newspaper, its TV stations, Newsweek magazine, the whole shebang, at just $100 million. But Buffett, just by adding up the value of its individual parts, he knew the business was worth at least $400 million. The pros were selling because they were scared the stock price might go down even more. Buffett was buying because he was getting $4 of real, durable business assets for every $1 he spent. It was that simple. This whole period was the ultimate real-world proof of his most famous piece of advice. He wasn't just talking the talk, he was walking the walk. While everyone else was gripped by fear, he was methodically and joyfully getting greedy. It was just an instinctive reaction for him. When America was being given away for cheap, he wanted to buy it. And so, the man who had been in limbo just a few years earlier, questioning his whole purpose, had found it again in the wreckage of the stock market. He wasn't just dabbling anymore, oh no. He was fully and completely back in the game, ready to make his mark in a way that nobody could have predicted. Just remember this number. This is the backdrop for everything, 580. From its peak, it was like 40% of American industry had just evaporated. The average stock was down an incredible 70% from 1968. This was the absolute bottom, the moment of maximum pessimism. And this is when Forbes magazine calls him up and asks him, so, Warren, how do you feel? And he gives them this unforgettable, perfectly folksy, and brutally honest answer. This is how he saw the market at its absolute lowest point. He wasn't scared. He was energized. His doubts were gone. His sap, as he put it, had never been higher. When you boil it all down, his actions during this crisis basically forged the playbook he became famous for. And it fits perfectly with his favorite analogy, baseball. First, he waited patiently, refusing to swing at bad pitches in an overpriced market. Second, he did his homework. He knew the real value of the business, separate from its crazy stock price. Third, and this is the most critical part, he completely ignored the roar of the crowd, separating his own emotions from the market's manic behavior. And finally, when that perfect pitch came right down the middle of the plate, he swung for the fences. Which leaves us with this one final thought. The numbers for the Washington Post, they weren't some big secret. The analysts on Wall Street could see the same values that Buffett saw. They even admitted the stocks were cheap. And yet, they were paralyzed. It really makes you wonder, if investing is so simple, why is it so hard? The story of 1974 suggests that the answer has less to do with math and a whole lot more to do with having the firmness of character to stand all alone. Everybody thinks they know Warren Buffett, the Oracle of Omaha. But for decades, lurking in the shadows was his alter ego, his secret weapon, the guy Buffett's own son thought was actually smarter than his dad, Charlie Munger. Their relationship was, well, it was a peculiar one.
A partnership so tight they almost seem like two halves of the same brain. But how did this duo, two guys with completely different personalities, build one of the greatest investment machines in history? Let me tell you, it wasn't through quiet agreement. It was forged in conflict, through high-stakes gambles, and even a full-blown federal investigation. So, to really get how they built this incredible company, we've got to follow their journey. First, we'll meet the men themselves, the original odd couple. Then, we'll see how a weird little business involving trading stamps and chocolate completely changed the way they thought about investing. After that, we dive into the Wesco Gambit, a corporate battle that put their skills to the test, which, you'll see, led to Washington knocking on their door. And finally, we'll see how all that pressure created the Berkshire Hathaway that we know today. All right, first up, let's meet the two guys at the center of our story. You know, their friends said they had this uncanny similarity in their wit and how they acted, but on the surface, Warren Buffett and Charlie Munger couldn't have been more different. I mean, just look at this. This contrast really says it all, doesn't it? Buffett was the cheerful diplomat. You know, the guy with an easy grace who hated any kind of confrontation. Munger, on the other hand, was, well, he was dour, deeply skeptical. In fact, he shot down so many ideas that Buffett nicknamed him the abominable no-man. But that's exactly what made them so powerful. Munger was the intellectual hammer that stress-tested every single one of Buffett's ideas. And this right here, this was Munger's superpower. His whole approach to everything was built on this one powerful idea. Instead of asking, how can we make this work, he would flip it on its head and ask, what are all the ways this could go terribly wrong? To understand a problem, you had to think about it backward. He once gave a high school graduation speech not on how to live a happy life, but on all the things you could do to guarantee a miserable one. This inversion, this was his secret weapon against doing something stupid. Okay, so let's see how these two very different ways of thinking started to blend in the real world. For a while, their careers were totally separate, but in the early 70s, they started to intertwine. And believe it or not, it all began kind of by accident, with a company that sold trading stamps you could trade in for stuff like toasters and lawn chairs. Now, both Buffett and Munger had been buying stock in this company called Blue Chip Stamps. But let's be clear, they weren't interested in the toasters. No, they were after something called float. Just think about it like this. Blue Chip got cash up front from supermarkets for the stamps, but they only had to pay out slowly over time as people redeemed them. And a lot of people never did. So that leftover cash, the float, became this enormous, interest-free loan they could use to buy other stuff. It's genius, really. And we're not talking about chump change here. The scale of their new war chest was just staggering. That float gave them $120 million a year to play with. A year! It was like running an insurance company, but without all the pesky regulations. So naturally, they took over Blue Chip's investment committee and started to go shopping. And their first major purchase with that Blue Chip money was See's Candy, a premium chocolate company out in California. And this was a huge moment. See, Buffett was a student of Ben Graham, so he was trained to buy just about anything as long as it was dirt cheap. But Munger pushed him. He said, Warren, forget cheap. Let's pay a fair price for a great business. And that was a massive shift in thinking for Buffett. The See's deal taught them a lesson that was absolutely crucial, the difference between book value and what Buffett later called intrinsic value. Book value is just the hard assets, the equipment, the inventory, the factories. But the real value of See's wasn't in its candy-making machines. It was in its brand name, its customer loyalty, all that future earning power. Those are the intangibles that book value completely misses, and that's what makes a business truly great. So now that they'd mastered this new way of thinking, they used the Blue Chip float to buy about an 8% stake in a savings and loan called Wesco Financial. It was a pretty minor investment, at first. That is, until Wesco's management announced a disastrous merger plan that would test their partnership like never before. Buffett and Munger knew instantly that this merger deal was just awful for Wesco shareholders. Buffett's first instinct was to just cut their losses and walk away. But Munger, the abominable no-man, said, no way, we fight. So for 6 weeks, they went on a buying spree, aggressively snapping up shares until they owned 20% of the entire company. Now they were in deep, and they had to figure out a way to kill this deal. Munger went in first. He met with Wesco's president, and his appeal was so Munger. He didn't just argue about the finances. He argued about morality. He said the directors shouldn't feel a moral obligation to go through with a bad deal. He came in like a man of honor, thinking two gentlemen could just sort this out reasonably.
while the other guy didn't budge. Munger's direct, logical, ethics-first approach, it totally failed. So Buffett steps up to the plate, and he takes a completely different tack. He doesn't bother with the president. He finds the one person with the real power to stop the merger, Elizabeth Peters, the largest shareholder and the daughter of the company's founder. He met her at the San Francisco airport, and he didn't argue about legalities or morals. He just spoke to her as a fellow owner, explaining that his capital was on the line right there alongside hers. And it worked. Peters was convinced she liked this guy. But then she asked the absolute killer question. What about the risk? What happens, she asks, if you get hit by a truck? And Buffett, without missing a beat, calmly replied that he had a partner, Charlie Munger, whose ability he considered equal to his own. He explained that Munger was designated to take over all his interests, including for his family if the truck ever came. And that answer, that absolute trust in his partner, that sealed the deal. Peters was in. The merger was dead. So they had won the battle for Wesco. Huge victory, right? Well, it was short-lived. Because this complex web of companies they controlled, Berkshire, Blue Chip, all these interlocking ownerships, had attracted some unwanted attention. The Securities and Exchange Commission was suspicious, and they came knocking. The SEC launched a full-scale probe. The official charge was stock manipulation. They suspected a conspiracy. They thought, these guys didn't kill the merger to protect shareholders. They killed it so they could take over Wesco themselves for a cheaper price. They subpoenaed everything. Suddenly, Buffett's entire life's work was under a federal microscope. And the SEC lawyers were just completely baffled by one thing. After the merger failed, the stock price should have collapsed, right? But Buffett and Munger have their brokers buy shares at the old, higher price just to be fair to the sellers who were getting out. The SEC just couldn't comprehend it. From their point of view, it made absolutely no sense. Munger's testimony was a masterclass in his worldview. He explained that their obligation wasn't just to squeeze every penny out of a single deal. It was about building a long-term reputation. This Ben Franklin idea was that being fair, even when it costs you money now, is the best business policy in the long run. The SEC lawyer literally admitted he was puzzled. I mean, the disconnect here was just profound. The SEC lawyers lived in a world of one-off transactions. Today's partner could be tomorrow's enemy, so why on earth would you care what the management of a company you just fought thinks of you? To them, reputation was just some fuzzy concept that had no place on a balance sheet. Then Buffett chimed in with this simple, powerful explanation. To him, a business wasn't just a pile of assets, it was a partnership with people. For their whole model to work, they needed the trust and respect of the managers who were running their companies. It wasn't just a transaction, it was a relationship. The whole conversation felt like it was happening between two different centuries, with Buffett sticking to this old-fashioned code of honor that the lawyers only saw as suspicious. The investigation dragged on for 2 long years. And while they were eventually cleared with not much more than a slap on the wrist, the whole thing left a deep scar. Buffett was, and this is a quote, sick to death of the complexity. The pressure from the SEC forced him to do something that would define the rest of his life. He undertook what he called a great simplification. He sold off all the complicated assets, he merged his different holding companies, and most importantly, he folded everything into one single company, Berkshire Hathaway. The last step, he merged his company with Munger's, officially making Charlie the vice chairman and giving him a 2% stake. Their informal handshake deal was now legally set in stone. This changed absolutely everything. Buffett no longer had a bunch of different pockets to manage. He had just one, Berkshire Hathaway. His entire fortune, his reputation, his life's work, it was all now inside this one public company. And that created an incredible singular focus that would power Berkshire's growth for the next 50 years.
In the end, just like Buffett himself told the SEC, Berkshire had become his life's work, the canvas he would spend the rest of his life painting. That intense fire from the Wesco battle and the federal investigation, it didn't break their partnership. It forged it into something stronger, simpler, and more powerful than ever before. This whole ordeal created the very foundation for the masterpiece we know today.
You know, sometimes the most incredible stories are about the most unlikely friendships. This one's about a publisher who was secretly terrified of numbers, and a folksy investor from Nebraska who saw the world in a way no one else did. Their partnership, well, it didn't just save a legendary newspaper, it completely redefined how to build a business empire, one brilliant, totally counterintuitive decision at a time. This is the story of Katharine Graham and Warren Buffett. Now, to understand this story, you've got to understand the world Katharine Graham was living in. That quote, that was a direct threat from President Nixon's own Attorney General during the whole Watergate scandal. The Washington Post, with her at the helm, was a political powerhouse, literally taking on the most powerful office on the planet. I mean, the stakes just could not have been higher. But behind all that journalistic courage was a secret that scared her even more than the White House: Wall Street.
So here's how we're going to unpack this incredible story. First, we'll look at Kay Graham, this powerful publisher who is really living in the shadows. Then, boom, the Oracle from Omaha arrives on the scene. We'll break down the Buffett doctrine he taught her, see how they built a financial fortress, and then witness this absolutely daring gamble on a failing insurance company. And finally, we'll look at the incredible billion-dollar result of their partnership.
All right, let's start with Katharine Graham, because long before she was this titan of industry, she was, in her own words, painfully insecure. She was thrust into a role she never wanted and felt completely, utterly unqualified to handle.
Her father had actually bought the Post out of bankruptcy way back in '33, but Kay was never, ever supposed to run it. She was just catapulted into power in 1963 after the tragic death of her husband, and she really saw herself as just a caretaker, just holding it together. And yet, she finds her footing. She makes these incredibly brave journalistic calls, like publishing the Pentagon Papers when all her lawyers were screaming, "Don't do it." But then, in 1973, her trusted financial advisor dies, and all that terror, it just comes rushing back. She was now in charge of a Fortune 500 company, and she was totally, completely lost. And this slide right here, it just shows you the huge gap between her public courage and her private fear. She called herself shy, self-abasing. She honestly believed a man would be better for the job. Her male colleagues often treated her with this sort of condescending air, and she even admitted, "I sort of thought figures were for men." I mean, think about that. She was a giant in the world of journalism who felt like a total imposter in the boardroom. And here's the problem, boiled down to a single number. For all its political influence, for all the awards, the Washington Post was a pretty mediocre business. A 10% profit margin? Frankly, it was nothing to write home about. It was this famous, powerful institution that just wasn't very good at making money. And this financial weakness was a constant source of anxiety for Graham. And it's on this stage that a mysterious new character is about to appear.
And so our second act begins. An unknown investor from Omaha, Nebraska, starts quietly but persistently buying up Washington Post Company stock. But inside the Post, this isn't seen as a vote of confidence. Oh no, it's seen as an attack.
This was the question echoing through the halls of the Post. There was genuine alarm. Kay's own son, Donald, was worried they were being targeted by some super right-wing type out to get them. Kay herself was, and I'm quoting her editor Ben Bradley here, petrified. She was stalking this unknown buyer, this Warren Buffett, like a dog circling a snake. She was absolutely convinced someone was making a hostile run for her family's company.
But here's the crazy part. Buffett's actions were the complete opposite of some hostile takeover artist. The company feared a right-wing ideologue. Buffett writes her this charming letter talking about when he used to deliver the Post as a paperboy. They thought he was making a run for them. He actually offered to stop buying stock just to calm her down. Her savvy, streetwise advisors from Wall Street were warning her, don't go near him. But Buffett simply told her his plan was to hold the stock permanently. He wasn't an attacker. He wanted to be a partner. And this quote, this is the moment the whole dynamic shifted. Ignoring all her advisors, Graham agrees to meet with Buffett. And as she invites him onto her company's board, she reveals all her vulnerability with this incredible line. She wasn't some hardened CEO. She was someone who needed a guide, a teacher. And Warren Buffett, who never needed to be told to be gentle, was about to become the most important teacher of her entire life.
So, this is where the story pivots from a corporate drama to a one-on-one masterclass in business. Buffett literally becomes Graham's personal tutor. He'd meet her in her bookline study in Georgetown and patiently explain the entire world of finance, not with a bunch of jargon, but with simple, powerful ideas. And the very first principle he taught her was this one. He said, stop thinking about overall company growth. It doesn't matter if your revenues get bigger if the value for each individual owner, each shareholder, doesn't. The only thing that truly matters, he said, is growth per share. It was a completely radical shift in focus, away from just building a bigger empire to creating real, tangible value.
Now, Graham thought this was totally nuts. If a company just gives its capital back to shareholders, how on earth can it grow? So Buffett explained it with this simple, absolutely brilliant analogy.
He said, think of your company as a pizza. The shares of stock, those are the slices. Now, if you use your profits to buy back and get rid of some of those slices, the pizza's total value hasn't changed. It's the same size pizza. But now, every single remaining slice is bigger. There's more cheese, more value for every owner who's left. It was a totally counterintuitive idea, but once she saw it like that, she couldn't unsee it.
So, armed with this new doctrine, this new way of seeing the world, Katharine Graham was ready to face the brutal world of business. She wasn't just guessing anymore. She had a framework, a philosophy, and a brand new confidence.
And boy was she tested, like immediately. During a vicious pressman's strike in '75, she was terrified the paper would lose the war even if it won the battle. Buffett was her rock. He just calmly monitored the paper's underlying franchise value and kept assuring her it was solid. Later, when the rival Washington Star was failing, everyone urged her to make a deal to keep it alive. Buffett argued against it. She made a tough counteroffer instead and the Star folded, which created a massive windfall for the Post. And then through the '80s, when every media company had acquisition fever, Buffett was that voice of restraint, keeping her from overpaying and watering down shareholder value.
And this right here, this gets to the heart of his most radical piece of advice. In an era where CEOs were celebrated for making huge, splashy acquisitions and building giant companies, Buffett's counsel was simple. Sometimes the smartest move is no move at all. It was okay not to spend the money. True strength came from discipline, from protecting your profitable core business, not from mindless expansion.
Now, the Washington Post wasn't the only Washington institution Buffett had a bit of a sentimental attachment to. The second case study of his philosophy is even more dramatic. It involves a company on the absolute brink of total collapse, and it's what really solidified his reputation as a true oracle.
I mean, just look at this collapse. It is breathtaking. Geico, this massive auto insurer, saw its stock plummet from $42 to just $2 in 2 years. This wasn't a dip. This was a nosedive straight into oblivion. The company had been lying about its losses, they'd expanded recklessly, and they were on the verge of becoming the biggest insurance failure in American history.
So the question is obvious, right? Why on earth would you put your money into what Buffett himself called the Titanic of the insurance world? Every smart person on Wall Street was running for the lifeboats as fast as they could. But Buffett, well, he saw something that nobody else did.
This was his assessment. He understood that Geico's management was a complete disaster, but its underlying business model, this low-cost operation that gave it a permanent edge over all its competitors, that was still perfectly intact. Just like with the Post during the strike, he could see this magnificent, durable business hiding underneath all the temporary chaos. He knew if they could just survive the storm, the profits would come roaring back.
And Buffett didn't just invest, he became the company's savior and its teacher. And during his talks with the new GEICO executives, he would share these little parables, like this one. He'd say, imagine you have a punch card with only 20 slots on it for your entire investing life. You would become incredibly selective, wouldn't you? You'd wait for the absolute best ideas. You wouldn't swing at every pitch. You'd wait for that perfect one. And for Buffett, GEICO was one of those 20 punches.
So, we come to the final act. We've seen the theory, we've seen the real-world tests. Now let's look at the absolutely staggering results of this partnership between the publisher and the oracle.
The numbers, well, they really speak for themselves. In just 11 years, following Buffett's pizza slice strategy, the Post bought back and retired 40% of its own stock. Now net profits grew 7 times over, which is great, but because of the buybacks, earnings per share, the cheese on each slice, grew by a factor of 10. The stock price compounded at 35% a year, and Buffett's initial $10 million investment? By 1985, it was worth over $200 million. It was an absolute masterstroke.
And it all leads to this final question. The financial returns were astronomical. There's no doubt about it. But this story suggests those returns were built on something far more valuable than just capital. They were built on character, on the trust between a student who was willing to learn and a teacher who was willing to guide, on the discipline to say no and the courage to act when everyone else was frozen by fear. It's a powerful reminder that in business, just like in life, the greatest fortunes are often forged not in spreadsheets, but in friendships.
When you think of Warren Buffett, what comes to mind? Probably brilliant, patient, stock picking. But back in 1977, he made one of the absolute riskiest bets of his entire career. And it wasn't on a stock. It it was on a whole business. By buying an afternoon newspaper in a declining Rust Belt city, he kicked off a brutal 5-year war that would test everything: his reputation, his finances, and his entire philosophy.
So, to really get what this whole fight was about, you've got to understand the prize he was after. See, Buffett wasn't just buying a newspaper. He was hunting for something he loved to call an unregulated toll bridge. Think about it, a business with such a lock on its market that it could basically charge whatever it wanted. This one metaphor, it's the key to the whole saga. It was his motivation, and for a while there, it was almost his undoing.
All right, let's set the scene. It's 1977. We're in Buffalo, New York. A classic steel town that's, well, it's seen better days. And the newspaper industry itself, everyone thinks it's a dinosaur. So why on earth would Warren Buffett, the master of finding hidden value, choose this exact spot to make his biggest investment ever? Well, because he saw something that everybody else was missing.
The Buffalo Evening News was, well, it was a total contradiction. On the one hand, it was a local powerhouse. It reached a higher percentage of households than almost any other big city paper. It had this incredibly loyal blue-collar readership. But on the other hand, the risks were terrifying. It was an afternoon paper, and that format was dying out. It didn't have a profitable Sunday edition, and it was saddled with 13 powerful unions that had gotten some of the best pay in the whole country. This was no simple, safe bet.
Despite all those red flags, Buffett, who was bidding through his company Blue Chip Stamps, put down $32.5 million. Now you have to realize, at the time, this was by far the biggest purchase he had ever made. He wasn't just buying some shares he could dump tomorrow, he bought the whole company, the printing plant, everything. He was personally on the hook for this.
Now, you have to understand, Buffett wasn't buying the evening news just to, babysit it into retirement. No. From the second that deal was done, he had a really aggressive, expansionist plan in mind. A plan that was basically a declaration of war on his only competitor in town.
So let's look at the battlefield, right? The Evening News, Buffett's paper, totally dominated the daily circulation. I mean, it was more than double its rival, the Courier Express. But the Courier's secret weapon was Sunday. It had a complete monopoly. And that single Sunday edition, with its 270,000 readers, was pretty much the only thing keeping the whole newspaper afloat. So what does Buffett do? He goes straight for the jugular. His first big move was to launch a Sunday edition of the Evening News. Now, this wasn't just about competing for a few readers. This was an existential threat. It was a direct shot at the one and only pillar holding up the entire Courier Express. The war was officially on.
But here's the twist. The Courier Express doesn't just fight back with price cuts and promotions. Oh no. Just 2 weeks before Buffett's first Sunday paper was supposed to hit the streets, they launch a surprise attack, a massive antitrust lawsuit. And just like that, this business battle turned into a legal and public relations nightmare for Buffett.
And the allegations? They were absolutely explosive. The lawsuit painted Buffett as this predatory monopolist, this big brother from Omaha who was using all the profits from his weekday monopoly to fund a price war. A war designed to do just one thing: drive the locally owned Courier Express completely out of business so he could own the whole town.
So the whole thing moves into a courtroom, and the lawyer for the other side, a guy named Frederick Firth, was, let's just say he was a showman. He goes right after Buffett on the stand. He doesn't just question the numbers, he questions Buffett's character, trying to paint him as this cold, calculating outsider.
But Buffett, he was the complete opposite. He was just a rock. He replied evenly, factually, and he absolutely refused to be baited. While this lawyer Firth was playing to the jury and the press, Buffett was like a human backboard, just calmly deflecting every single attack with pure logic and reason. He wasn't performing, he was just explaining.
And then came the moment that really turned the trial on its head. Firth weaponized Buffett's own metaphor against him. He brings up the unregulated toll bridge, using a quote from a friend in a Wall Street Journal article to prove Buffett's intent. And the argument was simple. This guy doesn't want to compete. He wants to own the only bridge into town, and he's willing to destroy his rival to get it.
This argument was powerful, so powerful that the Courier Express asked the judge for something called an injunction. Now, you need to know, an injunction is basically a legal bombshell. It's a court order that can stop a company dead in its tracks, telling them they cannot continue with their business plan.
And then, in a stunning blow to Buffett, Judge Bryant granted it. He ruled that Buffett likely did have the specific intent to monopolize,
I mean, the verdict was devastating. It legally handcuffed the launch of his Sunday paper, and maybe just as important, it painted Warren Buffett as the bad guy in the public's eyes.
That court ruling, it wasn't the end of the fight. Not even close. It kicked off a new and even more brutal phase. It started a 5-year war of attrition where Buffett was losing millions of dollars, fighting a hostile public, and battling his own unions.
And look, this wasn't some quick skirmish. The legal battle alone dragged on for 2 years until that injunction was finally reversed on appeal. But just when he was finally free to compete, bam, he had to face down a crippling union strike that threatened to shut the whole paper down for good. It was just a long, grueling siege.
And a financial toll, it was staggering. The paper was just bleeding money, losing a total of $12 million before taxes over the course of the war. Now, to put that in perspective for you, that was nearly a fifth of Buffett's entire personal fortune at the time. His partner, the famous Charlie Munger, even wrote to shareholders that they might never get their investment back.
And then, after 5 long years of bleeding money, battling in court, fighting in the streets for every single reader, the war ended. And it ended suddenly.
In September of 1982, the Courier-Express announced it was shutting down, ceasing publication. It just couldn't sustain the losses anymore. And just like that, the fight was over. Warren Buffett had won.
And the payoff? It was immediate, and it was immense. With its competitor gone, the paper, now called the Buffalo News, became a true monopoly. In its very first year piece, it earned $19 million in pre-tax profit, more than making up for all those wartime losses. And soon it was generating over $40 million a year. Buffett had finally built his toll bridge.
But this victory, it came with a very cold dose of reality for his employees. Soon after the Courier-Express folded, Buffett told his managers that the journalists up in the newsroom, the very people who had fought on the front lines of this war, could do nothing to affect profits now. The message was crystal clear. The owners took the risk, and the owners were going to get the rewards.
And the impact in that newsroom was stark. Before Buffett, the paper's union journalists had the 7th highest pay scale in the entire nation. In the years after his victory, that ranking slipped all the way down to 30th.
But maybe the most revealing piece of this whole story is something Buffett himself wrote 5 years before he even bought the paper. He said that second newspapers in a city were, for all intents and purposes, doomed. He knew the economics of the industry pretty much dictated that, in most cities, there could be only one survivor.
Which leaves us with a really fascinating question, doesn't it? Was Buffett just accelerating something that was going to happen anyway, giving the invisible hand of the market a little push? Or, knowing that only one paper could survive, did he march into Buffalo with the specific intent to destroy a competitor and build his profitable toll bridge right on top of the rubble? That's the complicated legacy of Buffett's newspaper war.
You know, when we think about Warren Buffett, our minds usually jump to some legendary stock pick, right? But today, we're going to dive into a period in his life, back in the late 1970s, that wasn't about a single investment. It was about a deep, personal crisis that was happening at the exact same time he was laying the groundwork for one of the greatest investment runs in history. We're going to see how his private world unraveling and his public genius reawakening were really just two sides of the very same coin.
So let's start with this quote from his wife, Susie. I mean, on the one hand, it's kind of affectionate, but it's also incredibly revealing, isn't it? It just perfectly captures the emotional gap that had grown between them after a quarter-century of marriage. See, Buffett was so intensely focused on his work. He might have been physically present, but his mind was a million miles away. And Susie, who was very emotional and social, she needed a whole lot more than that.
So here's the game plan for today. We're going to be weaving back and forth between his personal life and his professional life, and we'll see how the end of one chapter actually fueled the beginning of a whole new one, from a marriage falling apart to an absolutely incredible triumph on Wall Street.
Okay, so by 1977, the Buffetts were pretty much living separate lives under the same roof. While Warren was all in on buying newspapers and traveling for business, Susie was off launching her own singing career, auditioning in New York, and even getting signed by the William Morris Agency. Their kids were grown and out of the house, and the space between them, well, it was just getting wider and wider. This timeline really paints the picture, doesn't it? Their lives were just moving in completely opposite directions. A friend of theirs even had a cartoon made for their 25th anniversary that showed them as those little figures on a wedding cake, just constantly spinning right past each other. And this wasn't just a metaphor. I mean, he'd come home, she'd be hosting friends, and he'd just vanish into his study to read. And then, right after this star performance she gave in Omaha, Susie made a move that just completely shattered the carefully constructed world that Warren had built around himself. At 45 years old, she decided she wanted to live on her own. She was moving out. This is how Buffett described his absolute devastation to his sister. Now, Susie's move to San Francisco, it wasn't a legal separation or anything. She told him they were still husband and wife. But for Warren, it was just a massive blow. It left him feeling totally undone, miserably lonely. He was even bursting into tears on the phone with her.
And here's where we see this really profound disconnect. Inside, Buffett was in complete turmoil. But on the outside, his daughter came to stay with him, and she noticed that almost nothing about his daily routine had changed at all. She said, if you just played a tape of her mom opening and closing the door, you'd think she was still there. He was terrified of change, but he seemed completely blind to all the signs that led up to it.
Because Buffett dreaded change so much, a regular divorce was just completely off the table. So instead, he and Susie came up with a solution that was, well, to put it mildly, pretty unconventional. It was an arrangement that baffled basically everyone around them, but somehow it worked for them.
The whole thing actually started with Susie. From San Francisco, she started encouraging her friends back in Omaha to check on Warren. Take him to a movie, make him dinner. One of those friends was this witty waitress named Astrid Menks. She started just by bringing him soup, but within a year, she'd moved in. And they created what you could only really call a ballet à trois. Astrid handled the day-to-day life in Omaha, while Susie stayed his wife, his travel companion, and his partner at all the formal events. Okay, so let's shift gears completely. At the exact same moment his personal life is being totally rearranged, Buffett is looking out at the American economy, and he's seen the opportunity of a lifetime. The whole country was in this deep funk, but for a true contrarian like Buffett, that just meant it was hunting season. This infamous magazine cover, it just says it all. The late 70s were brutal. Inflation was hitting 13%, and the national mood was just one of decline. The consensus on Wall Street was clear. Stocks were over, a relic of the past. Investors were pouring money into gold, real estate, even rare stamps, literally anything but stocks. But this is where Buffett's genius just completely reframes the whole situation. While everyone else is panicking, he looks at the companies in the Dow Jones average, and he sees that, as a group, they were earning about 13% on their book value. So he started thinking of the Dow itself as a single Dow bond with a 13% coupon. I mean, that was way better than actual government bonds. The real value was right there, just hidden under a mountain of fear. He saw all these so-called professionals acting with what he called a record for cowardice. While they were all waiting for the economic outlook to get clear, what was Buffett doing? He was buying. He wrote this famous essay for Forbes at the time, arguing, the future is never clear, you pay a very high price in the stock market for a cheery consensus. Uncertainty actually is the friend of the buyer of long-term values. And maybe it's not a coincidence that the period right after Susie left was when Buffett really found his public voice. He'd always wanted to write and teach, and he basically turned the Berkshire Hathaway annual letters into his personal stage. He started writing these brilliant, crystal-clear business lessons for all of Wall Street to read. And in these letters, man, he did not pull his punches. He took direct aim at the flawed thinking of other CEOs, mocking their obsession with building empires instead of focusing on profits. He was especially brutal about their belief that their managerial kiss could magically turn some mediocre company into a great one. As he put it, we've observed many kisses, but very few miracles. This table just lays out the difference in his approach so perfectly. See, he wasn't trying to attract short-term stock traders. He was consciously building a tribe of long-term partners. He treated his shareholders like the co-owners they actually were, giving them honest updates and even letting them direct the company's charitable giving, which was a totally revolutionary idea back then. So, how does this whole story come together? We've seen the personal turmoil, we've seen the professional conviction. Now let's look at the results, because this whole period ends with the validation of his strategy on a truly historic scale. So it's August 1982. After years of economic misery, this was the Dow Jones Industrial Average, 777. I mean, unbelievably, it was actually lower than it had been 15 years earlier. That death of equities idea seemed very, very real. Now look at this number. By the end of 1983, just a little over a year later, this was the price of a single share of Berkshire Hathaway.
The market had finally woken up, and the portfolio Buffett had so carefully built just went into orbit.
The crucial point here is just this staggering contrast. While the entire market, the Dow, had basically gone nowhere for almost 2 decades, the vehicle Buffett was steering had produced returns that were, well, they were breathtaking. All those years he spent buying when everyone else was selling paid off in a way that almost no one could have possibly imagined. This quote from an interview, it really gets to the heart of the whole thing. In his personal life, with help from Susie and Astrid, he engineered a support system that gave him the stability he absolutely needed. And in his professional life, by attracting long-term partners, he built a company that let him operate exactly the way he wanted to. Both of these unconventional arrangements were built for one single purpose: to let him focus, completely uninterrupted, on his life's work. Which brings us to our final thought. When you look at the really unusual personal life and the intense professional discipline, what do you see? Do you see a story of deep personal sacrifice just for the sake of a career? Or do you see a masterclass in ruthlessly structuring your entire world to achieve one singular goal? It's a fascinating question about the nature and maybe the true cost of genius.
All right, let's set a scene. Imagine you're a big-time investor. You've got all the money, all the know-how in the world, and you're looking at a business, asking yourself a really simple question. How would I feel, really, about competing against this company? Well, for Warren Buffett, probably the greatest investor of our time, his answer to that question about one particular business, well, it was something else. I would rather wrestle grizzlies. Just let that sink in for a second. What kind of company, what kind of corporate monster could make Warren Buffett say that? You'd think it'd have to be some global tech giant, right? Or a massive international bank? Nope, not even close. The competitor that he was so terrified of was a 4'10", 89-year-old woman named Rose Blumkin. And the story of how she earned that kind of fear and respect, well, it's one of the greatest business lessons you're ever going to hear. So our story really kicks off in the summer of 1983. Warren Buffett walks into this absolutely massive store in Omaha, Nebraska, called the Nebraska Furniture Mart. Now, he's not there to buy a couch. He's there to meet its legendary founder, Mrs. B, and make a deal that would literally go down in business history. He just walks up to Mrs. B and asks if she'd be interested in selling. She says yes. How much? Buffett asks. $60 million, she says, without skipping a beat. And right then and there, they shook hands. $60 million. That was, by far, the biggest deal Buffett had ever done, sealed with a handshake. Incredible. And here's the part that's just wild. The deal was done on a single page. Buffett didn't ask for an audit. He didn't send in a swarm of accountants to pick through the books. Nothing. He made this huge $60 million decision based entirely on his gut feeling about Mrs. B's character. His thinking was, look, if you can't trust the Blumkins, why would you even want to be their partner in the first place?
And this quote, this just perfectly sums up the kind of partner he was getting. As soon as the ink was dry, this is what she said to him. Not, we'll maximize shareholder value. Nope, just a straight-up, brutal declaration of war on the competition. To really get why Buffett was so thrilled by this, you have to understand who this woman was and where she came from.
To really appreciate Buffett's absolute awe of her, you have to understand the journey of Rose Blumkin. It's almost unbelievable. Her story starts in a tiny village in Russia and ends with her building a massive American empire. It's the kind of rags-to-riches story you see in movies, but this one was real.
I mean, just look at this timeline for a second. She was born in a poor village in 1893. She flees Russia during a war, starts a business from scratch during the Great Depression with only $500. And then, less than 50 years later, she sells a big piece of it for $60 million. That trajectory is it's absolutely astonishing.
You know, her early life, it forged her into something else. We're talking about extreme poverty, sleeping on straw, one of 8 kids. She never went to school for a single day, but she was getting an education in survival and hard work in her mom's grocery store from the time she was 6 years old. On top of all that, she witnessed unspeakable violence. That kind of childhood creates a different kind of person.
And her grit was just on another level. When she decided she was getting out of Russia in 1917, that was it. Nothing was going to stop her. She had no passport, so she bluffed a border guard by promising him a bottle of vodka she didn't have. Then she crosses a continent and gets on a peanut boat to come to America. Can you even imagine? That's who we're talking about here. And when she got to America, it was the same story. She started with absolutely zero. She learned English by listening to her own kids. She started selling some used furniture out of her basement until she scraped together just enough, $500, to open a tiny little storefront. It was pure, relentless, step-by-step grind. And the business she built, it turned out to be the perfect example of everything Warren Buffett would eventually look for in a company. It was like she was this character he had dreamed up to show the world what a truly great business looks like, boiled down to its simplest virtues.
This was her entire business plan. Right here, 5 words: sell cheap and tell the truth. Now, it sounds almost too simple, right? But that was the absolute foundation of her empire. While everyone else was getting complicated with their marketing, she just focused on 2 things: having the lowest price, period, and being completely honest with her customers. And man, did it work.
So here's the secret sauce. The Blumkin formula. First, she'd buy her inventory in absolutely massive quantities to get the lowest possible price from suppliers. Second, she ran the whole operation with razor-thin expenses. And then, this is the key, she passed all those savings onto her customers. Get this, she would often sell furniture at just 10% above what she paid for it. Her competitors couldn't even dream of surviving on margins like that. And was she tough? Tough doesn't even begin to describe this woman. When the big carpet manufacturers refused to sell to her because she was undercutting everyone, you know what she did? She found ways to bootleg their products from other cities. When a bank loan almost put her under, she swore off debt for good. When a tornado literally ripped the roof off her store, she just kept selling furniture the next day with a tarp over her head. You could not stop her. Okay, so you can imagine that toughness also applied to her staff. She could be absolutely merciless, but there was a secret weapon, and his name was Louis, her son. He was the honey to her vinegar. So Mrs. B would scream at somebody, and then Louis would come by later and smooth it all over. She'd fire people, Louis would just quietly hire them back the next day. It was this perfect, if unconventional, partnership.
But what's really just mind-boggling is her focus. It was absolute. She had no hobbies. She never took a vacation. Her favorite movie? She'd say she was too busy. She worked 10, 12 hours a day, 7 days a week. The business was her life. I mean, her living room at home literally looked like another part of the showroom, with price tags still hanging off the lamps.
And this is where the story really clicks into place for Buffett. Because buying the Nebraska Furniture Mart threw one of his other investments into this harsh, painful light, his own textile mill, the original Berkshire Hathaway business. And this contrast between a truly wonderful business and a genuinely terrible one, it would change how he invested forever.
Buffett loves talking about this idea of a moat. You know, some kind of durable competitive advantage that protects a business, like a moat around a castle. Well, Mrs. B's business didn't just have a moat, it had the Grand Canyon. Her low-cost model was so powerful that huge national department store chains flat out refused to even sell furniture in Omaha. They knew they couldn't possibly compete with her. This side-by-side comparison, man, it just says it all. The Furniture Mart was a cash-generating machine. The textile mill, on the other hand, was a black hole for capital. In the textile business, the second one of your competitors buys a new, fancy loom, you have to buy one too, just to stay in the game. You're just constantly sinking money into a business with no real edge. But Mrs. B's business, it just got stronger and spit out more cash. For Buffett, this wasn't just a good deal. It was a complete game changer. The incredible success of the Mart, put right up against the slow, painful death of his textile mill, it led him to this massive realization about what kind of companies he should actually be buying.
And he finally admitted it. For years, he'd been following his teacher, Ben Graham's strategy of buying just okay businesses, but at rock-bottom prices. He called it cigar butt investing. But Mrs. B and her furniture store taught him a far more powerful lesson. It is so much better to buy a wonderful business at a fair price than a fair business at a wonderful price. His thinking and his own words had changed drastically.
And if you want the proof, just look at the final numbers. They're brutal. 2 years after buying the Mart, Buffett finally pulled the plug on the textile mill. These big looms he bought just 4 years earlier for $5,000 apiece, they were sold for scrap metal for $26. $26. And get this, he made as much money in 15 months in the furniture business as he had in 19 years in the textile business. And that, right there, that's the ultimate lesson from the carpet woman. What Buffett finally understood is that even the greatest manager in the world can't save a terrible business from its own economics. As he once said,
A horse that can count to 10 is a remarkable horse, but it's not a remarkable mathematician. And a brilliantly run textile firm is simply not a brilliant business. So, what's the difference? That's the question Mrs. B helped him answer. And it's the question every single one of us should be asking.
So let's talk about the 1980s. Wall Street, it wasn't just a place for business anymore. It was a battlefield. Seriously. On one side, you had this new breed of corporate raiders, and they were armed with this revolutionary weapon called the junk bond. And on the other side, well, you had the old guard of corporate America, who suddenly found themselves completely under siege. And caught right in the middle of it all was a man from Omaha, who was about to make the biggest bet of his life.
All right, picture this. It's 1984. Warren Buffett strolls into the office of the CEO of Time Inc., a huge media giant that everyone was whispering about as a takeover target. And he just asks him, point blank, how would you like a white knight? He was offering to be their savior, right? Their protector in these incredibly shark-infested waters.
So what do you think the board of directors of one of America's most iconic companies said? They asked, who is Warren Buffett? I mean, can you even believe that today? It's just wild to think about. Before he was the Oracle of Omaha, a household name, he was, to them, just some guy they'd never even heard of. A guy they turned down, and boy was that a decision they would come to deeply, deeply regret.
Okay, so to really get why a company like Time Inc. was so vulnerable and why Buffett's offer was so huge, we've got to understand the world they were all living in. This was Wall Street's Wild West, a totally new era of deals, of debt, and a whole lot of danger.
And this chart, wow, it just lays out the sheer scale of this change. Look at this. In 1975, the total value of all merger and acquisition deals was about $12 billion. Okay, fast forward less than a decade to 1984, and that number had exploded. We're talking a tenfold increase to $122 billion. Wall Street had completely transformed from a service industry into a deal-making machine, and you can bet the executives on Main Street were absolutely terrified.
So you're probably asking, how was all this even possible? Well, the weapon of choice was something called the hostile takeover. See, unlike a friendly negotiation between two companies, the acquirer, or the raider, would just totally bypass management. They go straight to the company's shareholders with an offer. It was a direct assault on the corporate boardroom. And where did the money for these attacks come from? From this new, pretty controversial financial tool, the junk bond. These were high-risk, high-yield bonds. You could think of them as the jet fuel for these takeovers. A renegade firm, Drexel Burnham Lambert, basically perfected their use, and it allowed these raiders to raise just massive amounts of cash incredibly quickly to go after even the biggest, most established companies.
But you know, there was one more piece to this puzzle that really made it all click into place. The very idea of who a shareholder was had changed. The owners of America's biggest companies weren't loyal, long-term individuals anymore. Nope, they were professional pension funds and mutual funds. And what's their job? Get the best return, period. They had zero loyalty to management. If a high bid came in, they took it and ran, and that meant everyone was vulnerable.
And right into the middle of all this chaos steps Warren Buffett. But he wasn't playing their game. He came with a completely different philosophy. See, he wasn't there to break companies up for a quick buck. He was there to offer them a permanent home. This was the White Knight's offer.
And this, right here, this really lays out the two warring ideologies of the time. It's the Buffett way versus the Raider way. I mean, look at the contrast. The Raider way is all about hostile raids, fueled by tons of debt, with a quick exit strategy always in mind. Their goal wasn't really to run the company better, it was to transfer its value into their own pockets. But then you have the Buffett way. Friendly deals, building partnerships based on actual trust, and offering a permanent home to create real long-term value. This was nothing less than a fundamental clash over the future of corporate America.
Well, this whole clash, it really came to a head in what was, at the time, the biggest non-oil merger in history. This is the story of the 900-pound gorilla.
So the story kicks off with this phone call back in February of '85. Tom Murphy, who was the chairman of Capital Cities and a good friend of Buffett's, calls him up and says this. He says, "Pal, you're not going to believe this. I've just bought ABC. You've got to come and tell me how I'm going to pay for it." What an incredible line, right? It just shows you the deep personal trust these two guys had.
Okay, so the whole deal basically went down in 4 key steps. It all starts with the call. We just talked about. Murphy needs help paying for this massive ABC purchase, but right away Buffett spots the gorilla problem.
a fatal flaw Murphy hadn't even thought about. See, by buying ABC, their new, much larger company would become an even bigger, juicier target for the raiders. So Buffett proposes the solution. He, through Berkshire Hathaway, will become their stable, unshakable shareholder, the one guy who absolutely will not sell. But to get it done, he had to dive into the negotiation, and that meant battling ABC's own bankers to get the deal finalized.
And that's where we get this absolutely brilliant metaphor from Buffett. He told his friend Murphy, "You better have a 900-pound gorilla, somebody who owns a significant amount of shares who will not sell regardless of price." Think about that. In the jungle that was 1980s Wall Street, you needed a protector so big and so loyal that the predators wouldn't even think about messing with you. And Buffett? He was offering to be that gorilla.
And wow, did he back it up with some serious cash. Berkshire Hathaway invested $500 million for an 18% stake in the new company. Now, just to put that into perspective for you, this was 50 times, that's 50 times larger than his famous investment in the Washington Post. This was a massive, company-defining bet.
So while Buffett is over here building this fortress, the war is absolutely raging everywhere else. And to really understand what he was up against, we need to take a look at the other side of the fight. Welcome to the Predator's Ball.
And really, there's no better example of that Raider playbook in action than the takeover of Revlon. The Raider here was a guy named Ronald Perlman. His target, the cosmetics giant Revlon. His weapon, a mountain of those junk bonds from Drexel. The tactic was a classic hostile takeover. Now, Revlon's chairman, he was this aristocratic guy named Michel Bergerac, and he was completely dismissive. He just said the company wasn't for sale. But Perlman proved him wrong. And the outcome? It was a watershed moment. It proved that with enough debt, absolutely any company was vulnerable.
Yeah, Perlman's victory, it just cemented the new, ruthless rule of 1980s Wall Street. The listen was brutally simple. Everything was for sale.
So this new reality, it really deeply bothered Buffett. And for him, it wasn't enough to just act differently. He felt like he had to speak out. This was a battle for the soul of American business, and Buffett was about to take his argument public.
So Buffett decided to go right at the Raiders' central argument, their main claim to fame. They always argued that they were the champions of the shareholder, that they were improving corporate America by unlocking hidden value. But Buffett started asking a very simple question. Was that really what was happening?
So in this huge speech he gave in 1985, Buffett just laid out his entire case. He argued that these takeovers weren't some noble process of economic Darwinism. No, it was more like corporate roulette, where even the best-run companies could become targets just because their stock happened to be temporarily cheap. He argued that raiders don't create value, they simply transfer it from the rest of society, through tax loopholes that favor debt, straight to shareholders. And finally, he said all this easy money pouring out of the junk bond market was just distorting business decisions and making people incredibly reckless.
And then he made a prediction. And at the time, this was just shocking, almost heresy. Right at the absolute peak of their power, when junk bonds were king on Wall Street, Buffett said this: "I personally think, before it's all over, junk bonds will live up to their name." What an incredibly bold call, and, as we now know, an incredibly accurate one.
So you have to ask, what was driving all this? Why was Buffett so completely different? Well, to get that, you have to understand a really core part of his character, something you might call the Buffett quirk. This deep belief he had that permanence was actually more valuable than profit. And he explained it in these really personal terms, which I think is fascinating. To him, selling a stock that you truly loved and understood was like marrying for money. It's a mistake in most cases, he said, but then he added, it's insanity if one is already rich. You see, he wasn't just investing for a financial return. He was trying to build permanent relationships. For him, staying with his partners, with his friend Murph, was just infinitely more satisfying than flipping a stock for a quick buck.
And that, of course, brings us right up to today. In a world of crypto, meme stocks, and this obsession with quick flips, Buffett's philosophy of permanence, it can feel almost quaint, can it? So the question we're really left with is this. In an age of just unprecedented speed and volatility, is the slow, steady, long-term approach of the 900-pound gorilla still the wisest bet?
Warren Buffett. I mean, the name itself is legendary, right? But, legends are often built on some very carefully constructed stories. So today, we're going to pull back the curtain on the myth of the Oracle of Omaha and find the really surprising truth that's hidden just behind that famous public face.
So get this, he doesn't walk on water? That was a real question asked by Forbes magazine back in 1986. And you know what? They weren't entirely joking. By the mid-'80s, the financial world, his own shareholders, even his peers, they had all started to see Warren Buffett as something, well, something more than human. People called him everything, a Midas, a wizard, the sage of Omaha. He'd become way more than just a successful investor. He was a genuine folk hero. He was this dispenser of down-to-earth wisdom who seemed to represent a simpler, more common-sense version of America.
And that's really the core question we're going to get into. What if that massive empire, that almost godlike reputation, was all built out of a tiny, quiet room in Omaha, Nebraska? What if the real key to all his complexity was just radical simplicity?
All right, so how in the world did this myth get so big? To really understand the man, you first have to appreciate the sheer scale of the legend around him. This wasn't just success we're talking about. It was a full-blown phenomenon. Take a look at this number. 167 times. In the 21 years leading up to 1986, if you had invested in his company, Berkshire Hathaway, your money would have multiplied 167 times over. I mean, just let that sink in for a second. It's a number that's almost impossible to wrap your head around. And to put that in perspective for you, over that exact same period, the Dow Jones Industrial Average, the entire market, it merely doubled. So Buffett wasn't just beating the market, he was completely rewriting the rules of the game. Now that kind of performance, it creates an almost religious following. I'm talking people were naming their dogs Warren. A money manager named his actual human son, Alexander Warren. And this one is just incredible. A guy read Buffett's biography to his wife while she was in labor, hoping to channel some of that magic. This was hero worship on a whole other level. The annual Berkshire Hathaway meetings, they became these pilgrimages. Hundreds and then thousands of his shareholders, his groupies basically, would fly into Omaha, not for some stuffy corporate meeting, but to feel a little of that vicarious brilliance, to just be in the presence of the guy who'd made them all rich. But okay, behind that enormous public persona, behind that whole cult of personality, was a man who lived a life of almost, well, monastic simplicity. And the contrast between the public myth and the private man is just staggering. Come anytime. I don't have a schedule. That was his actual response to a request for a meeting. Can you imagine a modern Fortune 500 CEO ever saying that? It's unthinkable. He intentionally kept his days wide open. His time was for thinking, not for managing other people's schedules. And his office was his fortress of solitude. There was no stock ticker flashing, no computer screen glowing. When somebody asked him about it, he'd just say, "I am a computer." His days were just long stretches of unstructured hours spent reading, thinking, and talking on a phone that he answered himself. And that simplicity, it carried over into every single part of his life. We're talking about a billionaire who ate Link sausage and eggs, drove his own car, and lived in the very same house he bought way back in 1958 for $31,500. He was the ultimate anti-billionaire. But here's the thing. This simplicity, it wasn't just a personality quirk. No, it was a very carefully cultivated part of his public image, and it was a crucial tool in his method. He was a master at telling his own story, at polishing his own history. He would just subtly tweak the edges of his own stories. He wasn't exactly lying, but he was definitely mythologizing. That story about the pinball machine being a joint venture, his friend remembered buying it alone. The racing tip sheet he published, it was a one-time deal scribbled in pencil. He even made his return to Omaha sound like it just sort of happened, but his investment partnership was up and running within weeks. His goal was to strip out the raw ambition, to make his incredible success feel less like a relentless drive and more like a happy accident. And this talent for storytelling was his #1 teaching tool. He loved to tell this one parable, the Ain't My Dog story. So it starts with a stranger in a small town who sees an old-timer sitting on his porch next to this really mean-looking German Shepherd. So the stranger, just trying to be friendly, he asks the old guy a simple question. "Does your dog bite?" The man just says, "Nope." So the stranger confidently reaches down to pet the dog and, bam!
The dog lunges and nearly takes his arm off.
So as the stranger is trying to patch himself up, he yells at the old man, "I thought you said your dog doesn't bite." And the old man calmly replies, "Ain't my dog." The moral for Buffett's managers was simple. It's not enough to ask questions. You have to ask the right questions. And that little parable, it perfectly sums up his whole corporate philosophy. His entire company was built to eliminate noise, to avoid the wrong questions, and to focus only on what truly mattered. He basically built a company that was a reflection of his own mind. I mean, just look at this. The world headquarters of this massive Fortune 500 company had a corporate staff of 11 people. 0 strategic planners, 0 PR people, 0 corporate lawyers. Buffett believed if you hired those people, they just create work for themselves and blur the focus. This was the ultimate anti-corporation. His management style was just as radical. He didn't schedule meetings with his managers. He didn't ask for earnings forecasts. He called them false precision. He made simple, take-it-or-leave-it offers for companies. And then he just trusted his managers to run their own businesses. That level of freedom was absolutely unthinkable anywhere else. Now, this unique style wasn't just something he kept in the office. It basically seeped into his entire life, blurring all the lines between his personal friendships, his family, and his professional life, creating this circle of what you could call apostles. He openly admitted to having 2 different personas. He was an extrovert on the road, but a total introvert at home. And this was kind of mirrored by the 2 most important women in his life. His wife, Susie, was his companion for his public life. But his partner back in Omaha, Astrid, she was the one who shared his intensely private, quiet home life. He advised his friends and managers with these same kinds of short, memorable parables. They weren't just his friends. They really became his disciples, his apostles, who would look to him for advice on everything from business deals to their personal lives. He turned investing into a philosophy for how to live. And really, this brings us to the final thought. Buffett's life seems to suggest that maybe genius isn't about managing complexity, but about ruthlessly getting rid of it. In a world that's constantly bombarding us with data and demanding our attention, maybe the most powerful and revolutionary thing you can do is to build your own fortress of solitude. And just think.
1987, the year the stock market went completely, utterly off the rails. It was a time of pure panic, hysteria, fortunes just wiped out overnight. But right in the middle of all this chaos, one man was the absolute picture of calm. This is the story of how Warren Buffett navigated one of the biggest financial storms in modern history.
So let's start with a quote from Buffett himself, and get this, it's from the very year of the crash. "I have never met a man who could forecast the market." Now that sounds kind of strange coming from an investment genius, doesn't it? Almost like he's helpless. But for Buffett, this wasn't a weakness. It was the absolute foundation of his strategy. You see, he didn't try to predict the rain. He built an ark.
And this really gets to the core question, right? When a market's logic just evaporates and raw fear takes over, what does a master of the game actually do? Well, the answer isn't just about finance. It's about discipline, it's about psychology, and frankly, it's about a fundamentally different way of seeing the world.
To really get what Buffett did during the crash, we first have to understand the mental model he uses for, well, pretty much everything. It's got nothing to do with crystal balls or gut feelings. For Buffett, life, and especially business, is a game of probability. It's all about playing with loaded dice.
And I mean this literally. This wasn't just some business tactic. It was his whole worldview. He'd calculate the odds on everything. There's a famous story where he won a bet that in a room of just 25 people, at least 2 would share a birthday. It shocked his friends, who had no idea the mathematical odds were actually over 60%. This mindset, it's the key. By cutting through all the noise and emotion and boiling a situation down to its core mathematical probability, he could see things that other people just completely missed.
This whole mindset is perfectly captured in the loaded dice game. He once challenged an executive, a guy named Jack Byrne, with 3 specially designed dice. He told Byrne, "Pick any die you want." Here's the trick. No matter which one Byrne chose, Buffett could always pick another one that had a statistical advantage. So of course Buffett won easily. Then they played again. Byrne switched to Buffett's winning die from the last round, and Buffett still won. You see, it wasn't a game of chance. It was a game of math. And that is exactly how he approached the insurance business.
This mathematical approach led him straight to the financial engine of his entire empire, something called the insurance float. Think about it. Insurance companies collect all this cash from premiums up front, right? But they might not have to pay out any claims for years, if ever. That massive pile of cash, the float, can then be invested for Berkshire's own profit. Buffett himself described the feeling this created as blissful, almost euphoric. It was like a constant river of other people's money that he could use to go out and buy more businesses.
Okay, so Buffett has this incredibly powerful cash-generating engine. But, having the engine and knowing when to hit the gas are two very, very different things. This next part is all about the unbelievable discipline he showed when the odds were not in his favor.
So back in the early 1980s, the insurance industry was just locked in this brutal price war. Everybody was slashing their prices to grab market share, even if it meant writing policies that were guaranteed to lose money. It was a total race to the bottom, all driven by this corporate obsession with steady growth at all costs. Buffett, he just refused to play. He saw it for what it was, betting against the odds. If a policy wasn't priced correctly to make a profit, he simply wouldn't write it, period. He was chasing profit, not volume.
So while all his competitors were chasing growth no matter the cost, Buffett was actually actively shrinking his business. Get this, from 1980 to 1984, Berkshire's insurance premium volume fell from $185 million all the way down to $134 million. Now, to any other CEO, that would look like an absolute disaster, but to Buffett, it was just common sense. He was refusing to play a losing game. He would just wait for the odds to change.
And then, by 1985, the inevitable happened. All those companies that had been recklessly cutting prices started suffering massive, massive losses. A lot of them went broke or just fled the market in terror. Suddenly, insurance was scarce, and prices, they skyrocketed. And who was left standing with a balance sheet like a fortress, ready to write policies at the right price? Buffett. In just 2 years, Berkshire's premium volume exploded from that $134 million to over $1 billion. He just waited for the game to be rigged in his favor, and then he went all in.
So by 1987, this incredibly disciplined strategy had left Berkshire absolutely stuffed with cash. We're talking a mountain of it. But this created a brand new and very serious problem. I mean, that was the dilemma, right? The stock market was in the middle of this historic bull run. Everything was insanely expensive. Trying to find a good business at a fair price, which is Buffett's entire strategy, was nearly impossible. He had already quietly sold off almost all of Berkshire's stock portfolio, but that cash from the insurance business just kept pouring in. He had to find a safe, smart place to park it. Well, the answer came from a phone call. John Gutfriend, the CEO of the investment bank Salomon Brothers, was in deep trouble. A corporate raider, Ronald Perelman, was threatening a hostile takeover, and Gutfriend desperately needed a white knight, a friendly investor to save him. So he called Omaha. Buffett saw an opportunity, for sure, but he flat out refused to just buy common stock in a wildly overvalued market. No, he proposed a different kind of bet entirely. He proposed investing $700 million, not in common stock, but in something called convertible preferred stock. Now, this is a brilliant financial instrument. It acts like a bond, so it pays a high, fixed dividend, in this case 9%, which gives you a steady, safe income stream. But, and here's the magic, it also comes with an option, a kind of lottery ticket, to convert those shares into regular common stock at a set price if the company does well. It was the perfect Buffett bet, downside protection with massive upside potential. So while Buffett was carefully structuring deals to protect his downside, the rest of the market was just throwing caution to the wind. To really appreciate the crash, you have to understand the sheer madness that came right before it.
The market just went on an absolute tear. A 44% rise in just 8 months. Think about that. It was a parabolic move completely disconnected from the reality of the businesses underneath. This wasn't investing anymore. This was pure speculation. It was a full-blown fever dream.
You know, every bubble has its rationalizations. People started saying things like this time is different, that all the old valuation metrics were obsolete. They believed a flood of foreign money would just prop up prices forever, and crucially, they put all their faith in new technology. There was this strategy called portfolio insurance that used computer models that were supposedly going to protect against losses by automatically selling stocks as they fell. It gave everyone this false sense of security, convincing them they could always get out before any real damage was done. They were tragically wrong.
And then, just as quickly as it all went up, the entire house of cards came tumbling down. The music didn't just fade out, it stopped with a horrifying crash. The unraveling was just swift and brutal. After record drops on October 6th, and then again on the 16th, the stage was set. Then came Black Monday, October 19th,
The Dow collapsed 508 points. That was a 22.6% drop in a single day. And that portfolio insurance that was supposed to protect everyone, it became the ultimate accelerant. Instead of just a few managers panicking, you had thousands of computers all executing sell orders at the exact same time, dumping billions of dollars onto a market where there was simply no buyers.
So in the aftermath, with financial titans totally ruined and the whole world looking for these complex explanations, what did Warren Buffett have to say? Someone asked him what the crash meant. His answer was so simple, so direct, so completely devoid of panic. He just said, maybe the market had gotten too high. That's it. No complicated theories, no blaming the computers, just a calm statement of the obvious.
And this really brings us to the ultimate lesson of the crash, a lesson that gets right to the very heart of Buffett's philosophy and the profound difference between the stock market and the real world.
You see, even a company like Berkshire Hathaway was not immune to the market's madness. On Friday, its stock closed at nearly $3,900 a share. By the end of Black Monday, it had fallen to $3,170. In a single trading day, a quarter of the company's market value, billions and billions of dollars, had just evaporated, gone.
But here's the central paradox. Were Berkshire's businesses actually worth 25% less on that Monday than they were on Friday? Of course not. Nothing had fundamentally changed. The Buffalo News was still selling papers, the insurance companies were still collecting premiums, the real, tangible businesses were identical, and yet the stock market had just declared them to be worth billions less.
So this forces us to ask a really fundamental question. If a company's value can be slashed by a quarter overnight, while the actual business itself is completely unchanged, then what does a stock price on any given day truly represent? Is it a measure of a company's real intrinsic worth, or is it just the last price at which two people, one who was anxious to buy and the other who was anxious to sell, just happened to agree? The crash of '87 didn't really provide an easy answer, but man, it sure framed the question in a way that no one could ever ignore again.
All right, let's dive right in. What we're about to unpack is one of the great intellectual battles of the 20th century. And no, it's not about physics or politics. It's about money. It's about madness, and it's about a deep, fundamental disagreement over how the world, well, how it actually works. This is the story of a stubborn guy from the Midwest who decided to take on the entire academic establishment, and his only weapons were common sense and a track record that was just impossible to ignore. Let's get into it. You know, this quote from Bernard Baruch, it just perfectly sets the stage for everything we're going to talk about. It frames the central conflict. On one side, you've got these beautiful, elegant, mathematical theories about how markets are supposed to behave. And on the other side, you've got us. You've got people. The messy, emotional, and, let's be honest, often totally irrational reality of human behavior. This whole story is about what happens when a beautiful theory gets punched square in the face by reality. Picture this. It's Black Monday. The market is in an absolute freefall. Chaos everywhere. And for Warren Buffett, who's watching this all unfold, it wasn't just some disaster. For him, it was vindication. It was the ultimate I told you so. He saw it as the final, definitive proof that the theories ruling Wall Street, the stuff they were teaching in every business school, were basically built on a fantasy. He felt the simple wisdom of his mentor, Ben Graham, had been tossed aside for what he called academic witch doctors, who were just peddling these bizarre, complicated formulas. Now, that crash, it didn't start this fight. Not at all. It just ripped the cover off a battle that had been raging just beneath the surface for decades. This was a war for the very soul of modern finance, and it pitted the most successful investor of our time against the most powerful academics in the world. It all really boils down to two completely opposite camps. On one side, you've got Buffett, the heretic. His whole life, his whole career, was built on one simple idea. Sometimes, the market just gets it wrong, and you can buy a piece of a business for way less than it's actually worth. But on the other side, you've got the academic orthodoxy, with their powerful doctrine, the efficient market theory. And their argument was that the market price is always the right price, that it instantly reflects everything. And to them, trying to beat the market wasn't just hard, it was a fool's errand. Buffett was just a weird sideshow. To really get this fight, you first have to understand the theory that absolutely ruled Wall Street. This idea became something like, well, a religion. It had what the source calls the power of sacrament, because it was so clean, so mathematical, and man, was it seductive. At its heart, the efficient market theory, or EMT for short, it sounds really simple.
It just says that the combined wisdom of millions of smart, rational investors make sure that a stock's price is the perfect reflection of its value at any given second. Any new piece of information, good or bad, gets absorbed into that price instantly. It's this beautiful vision of a perfectly logical, self-correcting machine. And the theory is built on this really powerful chain of logic. Follow me here. If today's price is already right, then the only thing that can possibly change tomorrow's price is new information, right? And since new information is, by its very nature, a surprise, well, then future price movements have to be completely random, unpredictable, which led them to the famous conclusion that the stock market just follows a random walk. Nobel laureate Paul Samuelson put it perfectly. He said, look, if you could be sure a price was going to rise, it would have already gone up. Think about it. Smart people would have already bought it, pushing the price up until the bargain was gone. In this world, there are no $100 bills just lying on the sidewalk because someone would have already bent over and picked them up. You never get something for nothing.
And here it is. Here's the punchline that actually shocked a Senate committee back in the 60s. If all the analysis in the world is useless because all the information is already baked into the price, and if the future is just random, then, logically, a portfolio picked by, say, throwing darts at the stock pages of the newspaper could do just as well as one managed by some expert getting paid millions. I mean, this theory didn't just question stock pickers, it basically called their entire profession a pointless waste of time. But there was one massive, glaring, inconvenient fact that this whole elegant theory just couldn't explain away. And that fact had a name: Warren Buffett. He was the $100 bill that was somehow still lying there on the sidewalk, year after year after year.
So the academic world, they had to come up with ways to explain him that didn't completely wreck their model. First, they said he was just lucky, like someone who happens to flip heads 20 times in a row. They even insinuated maybe he had inside information. They dismissed him as a 3 sigma event, which is just fancy talk for a statistical fluke so rare you can just ignore it. Or, and this is my personal favorite, they'd call him a genius, but in a way that meant he was some kind of freak of nature whose methods couldn't possibly be taught or copied by anyone else.
Buffett's response to all this? Oh, it was a classic. An unspoken taunt that just cut right through all the noise. He didn't need complicated formulas to make his point. His wallet did all the talking for him. It was this direct, folksy challenge to all the scholars in their ivory towers who were so sure that a guy like him couldn't possibly exist.
But you have to understand, this wasn't just about results or who was richer. At its very core, this was a profound philosophical fight. Buffett and the academics weren't just using different formulas. It was like they were speaking completely different languages. They couldn't even agree on the meaning of the most basic words in finance: value and risk.
So let's start with value. What is it? For the academics, it was dead simple. The price is the value. They're the same thing. The market has spoken, end of story. For Buffett, that was just absurd. He saw value as the intrinsic worth of a business, what it was really worth deep down. The market price? That was just an offer on the table, a quote from a crazy, moody business partner he famously called Mr. Market, who might be euphoric one day and suicidal the next.
Okay, and what about risk? Now this one is absolutely crucial. The academics, they needed a number, something they could plug into their equations. So they defined risk as volatility. And they measured it with a Greek letter, beta. A stock whose price bounced all over the place had a high beta, and therefore it was risky. To Buffett, this was just complete madness. Risk wasn't some squiggly line on a chart. Risk was simple. It was the chance that you could permanently lose your money because you were foolish enough to overpay for something. And Buffett's simple, powerful logic here just completely dismantles the academic definition. Just think about it. Imagine a great company. You know it's worth $100 million. The market panics and suddenly offers it to you for $40 million. A few months ago, it was trading at $80 million. Now, according to the academics and their beta, because the price fell so sharply, the stock is now more volatile and therefore more risky at the lower price. As Buffett says, that makes zero sense. The lower the price you pay, the less risk you're taking on. It's just common sense.
So all this tension, it all came to a head in 1984. And the setting could not have been more perfect. Columbia University, the very birthplace of value investing. Buffett was invited to speak to honor his mentor, and he decided, you know what, it's time. It's time to take on the academics' central argument, that whole coin flipping thing, head on. Buffett gets up there, and he starts with this brilliant thought experiment. He says, imagine a national coin flipping contest. Every single person in the United States, all 225 million of them back then, starts the day by flipping a coin. The rules are simple. If you flip tails, you're out. If you get heads, you move on to the next day. Now, just by pure probability, after about 10 days, you'd still have around 220,000 people left. And after 20 straight days of flipping heads, you'd be down to just 215 winners. Now, you can bet those 215 people would be feeling pretty good about themselves. They'd be writing books, My Secrets to Coin Flipping Success. But as Buffett pointed out, a professor would correctly say that if you'd started with 225 million orangutans, you'd end up with roughly 215 lucky orangutans. This was the exact argument the academics used against great investors. They weren't skilled, they were just statistical accidents. And then Buffett delivered the knockout punch. He asked the audience, but what if you found that a disproportionate number of those 215 winners, say 40 of them, all came from the exact same zoo in Omaha, Nebraska? Well, you wouldn't call it luck anymore, would you? You'd start getting real curious about what that zookeeper was teaching them. His point was undeniable. The great value investors, the consistent winners, they all came from the same intellectual zoo, the school of Graham and Dodd. It wasn't luck, it was a method. You'd think that would be the end of it, right? Buffett's speech, the '87 crash, devastating blows to the efficient market theory. But here's where the story gets really interesting. The theory's ghost, it still haunts us. It was wounded, badly, but it was far from defeated. I mean, the theory got hit with a brutal 1-2 punch. First, in '87, the crash proved markets aren't always rational. Then, in '92, get this, one of its own creators published a paper showing that beta didn't actually predict returns. And yet, the theory didn't die. Its core idea, that you can't beat the market, led directly to the explosion of passive index funds. The logic became, well, if you can't pick the winners, just own everything. So that leaves us with this really fascinating question for today. With trillions and trillions of dollars now invested passively, automatically, based on this old idea that you can't beat the market, has that very idea become a self-fulfilling prophecy? Or, by discouraging the hard work of real analysis, have we accidentally created the perfect hunting ground for the next Warren Buffett to find amazing bargains when that inevitable crowd madness strikes again? It seems to me this debate is a long, long way from being over.
All right, let's talk about one of the most legendary investments in financial history. It's a story that has it all. A billion-dollar bet, a secret that was hiding in plain sight, and one man who saw something that absolutely everyone else on Wall Street missed. So let's pull back the curtain on this one. So let's set the scene. It's the fall of 1988. The stock market is still pretty shaky from the big Black Monday crash a year before. And there's this feeling of anxiety just hanging in the air. And over at Coca-Cola's headquarters in Atlanta, a few executives started to notice something was off. Somebody, somewhere, was quietly buying up their stock. And not just a little bit, a whole lot.
And this buying, it was relentless, just day after day, methodical. More and more shares were being snapped up. Coke's chairman, Roberto Goizeta, and its president, Don Q, they're trying to figure out what's going on. I mean, who has this kind of money, and why are they being so sneaky about it? And then Q notices that all the trades are coming through one specific broker, out in the Midwest, and a light bulb just goes off. He knew exactly who it had to be, so he picks up the phone.
And the guy on the other end of that phone? Well, of course, it was Warren Buffett. And he wasn't just dabbling here. By the time he was finished in the spring of '89, his company Berkshire Hathaway had sunk over $1 billion into Coca-Cola. $1 billion back then is like $2.5 billion today. This wasn't just dipping a toe in the water. This was a massive company-altering bet on a single business. So when the news finally gets out, Buffett, who is famously known for drinking like 5 cherry Cokes a day, he just plays it off with that classic, charming style of his. He made it sound so simple, like he just decided to buy some shares of his favorite drink. But behind that simple one-liner was this deep, calculated, and honestly a pretty lonely conviction that pretty much no one else on the entire planet shared.
The experts, the so-called smart money on Wall Street, they were just scratching their heads. Their spreadsheets and models were all telling them that Coke was a mature company, that its best days were way behind it. One analyst even came right out and called it a very expensive stock. And this, right here, is the heart of our story. Buffett was betting a fortune on something the certified geniuses of the world thought was a mediocre idea at best. So what on earth did he see that all of them didn't?
Okay, to crack this mystery, you really have to get inside Warren Buffett's head. You have to understand how he looks at the world. It's not about complex charts or market timing. It's a completely different way of thinking from the rest of Wall Street, and it is the key to everything.
You see, for most people on Wall Street, a stock is just a ticker symbol, right? A little blip on a screen that goes up and down, something you trade. But for Buffett, no. A stock is a tiny piece of an actual business. He likes to compare it to a bond. A bond has these little coupons that pay you a fixed amount of money. Well, a stock, he says, has coupons too, but the amount isn't printed on them. Those coupons represent all the money the company is going to make in the future. And your job as an investor is to try and figure out just how much money those future coupons are going to be worth.
And he lives by this very strict set of rules, kind of like his personal playbook. First, he totally ignores all market predictions and what the economy might do. He thinks it's all just noise. Second, he only invests in businesses he can actually understand, what he calls his circle of competence. Third, he looks for managers who are honest and talented, who run the company like it's their own family business. Fourth, he does his own homework, reading the actual annual reports himself. And number 5, this one's the kicker. When he finds that golden opportunity, he doesn't just buy a little, he backs up the truck.
Now, here's where the story gets really interesting. Because applying that kind of thinking to Coca-Cola back in 1988 was not obvious at all. In fact, for decades, Buffett himself completely ignored the company as a place to put his money. And we need to figure out why.
I mean, the irony here is just off the charts. Buffett's very first business venture, when he was just 6 years old, was buying 6 packs of Coke and selling the bottles individually for a profit. He saw its power firsthand. And yet, for the next 52 years, as Coke became this global icon, he put his money into struggling department stores and dying textile mills. He was literally surrounded by the evidence of Coke's power, and he just walked right by it.
And you know, for a long time, he was probably right to stay away. In the 70s, Coke's management just kind of lost their way, getting into all these bizarre side businesses like shrimp farming of all things. Then, in '81, a sharp new CEO named Roberto Goizueta came in. But a few years later, he presided over one of the most legendary marketing blunders of all time. They changed the sacred formula and launched New Coke.
And while he was digging through all this history, Buffett stumbled upon this quote from an old Fortune magazine article about Coca-Cola from 1938. And it was a total revelation. For 50 years, smart, serious investors had been looking at Coke and saying the exact same thing. Yeah, it's a great company, but I missed it. The big growth is over. It was this timeless psychological trap that people had been falling into for half a century.
But that new Coke disaster, as bad as it was, it had this powerful, completely unexpected side effect. The public backlash was incredible. People didn't just dislike the new flavor. They felt like they'd been betrayed personally. And that was the moment that really proved to Buffett what Coca-Cola actually was. It wasn't just a soft drink company. The brand itself was a cultural landmark, woven into the happy memories of millions and millions of people.
So picture Buffett in the mid-'80s just poring over Coke's annual reports. And he starts connecting the dots. First, he realizes the new Coke fiasco had been a wake-up call for management. They finally understood the true power of their brand. And second, he could see they were now quietly and methodically transforming the entire business, unlocking a gold mine that was sitting right there in plain sight for anyone who bothered to look.
This is really where the engine started turning. The new CEO, Goizueta, he started getting rid of all that distracting stuff, selling off the side businesses to focus only on drinks. He started pumping money into their global network of bottlers, which is the lifeblood of the company. He became obsessed with profitability. And here's a move Buffett absolutely loves. He started using the company's huge pile of cash to buy back its own stock, making every remaining share more valuable. The giant was finally awake.
And this right here, this was the secret. This was the incredibly simple, powerful idea that Wall Street was just completely blind to. In 1988, the average American drank almost 300 Coca-Cola products a year, but the average person in the rest of the world, a measly 39. You see the gap? The international market wasn't just an opportunity, it was a vast, untapped ocean.
And you know, Coke's president at the time, Don Keough, he put it perfectly. He wasn't just seeing numbers, he was seeing a future that was practically guaranteed. He looked at a country like Indonesia, hot climate, huge young population, and a culture where soft drinks are a big deal, and he basically saw a limitless runway for growth. It was just simple, powerful demographics.
And the best part? The numbers were already proving him right. This wasn't some fantasy. Just look at this. Between 1984 and 1987, and get this, this is before Buffett even bought a single share, Coke's international profits almost doubled, and the chunk of their total profit coming from outside the U.S. shot up from about half to three-quarters of the entire company. The growth engine was already redlining, and it was getting faster. So you gotta ask, right? If all this stuff was public, just sitting there in the annual reports for anyone to read, why was Buffett the only one who really saw it and acted on it with such conviction? Well, the answer really has less to do with being a genius and more to do with your perspective and your temperament. It really came down to two totally different worlds. Buffett was looking at the big, simple things that last, an invincible brand with a huge protective moat around it, run by smart people with a clear path for decades of growth. Meanwhile, what was Wall Street doing? They were lost in the weeds. Their analysts were worrying about what the US dollar was going to do next quarter or trying to compare Coke and Pepsi by analyzing the price of potato chips. They were busy studying the leaves on the trees, while Buffett was looking at the entire forest. And this one quote from Buffett just sums up the whole thing. He knew that Coca-Cola's leadership around the world wasn't just an asset, it was an invincible fortress. It was so powerful in the minds of billions of people that you couldn't beat it, not even if you had $100 billion to try. So when you boil it all down, what's the big lesson here? What's the takeaway from this whole story? It's a really powerful one, and it goes way beyond just investing in stocks. You know, Buffett's real secret weapon here wasn't some complicated formula he cooked up. It wasn't an inside tip. It was something way rarer. It was the discipline to do his own homework, the clarity to see the simple truth that everyone else was ignoring, and then having the sheer guts, the courage to make a massive bet based on his own conviction, especially when all the experts were telling him he was crazy. And maybe the best way to end is with this thought from Buffett's longtime partner, the legendary Charlie Munger. The truly great opportunities in life, the ones that can change everything, they're not just lying there on the street for everyone to pick up. They take work, they take independent thinking, and more than anything, they take courage. Because if it were easy, everybody would do it.
Warren Buffett. The name is synonymous with wealth, one of the richest men in modern history. But you know, for a guy with that kind of monumental fortune, his ideas about money, well, they were something else, deeply unconventional. And today, we're going to unpack that paradox, the life of a billionaire full of contradictions.
Okay, let's start with this one quote, because it's really the key to unlocking everything about the man. He called huge inherited fortunes privately funded food stamps. Think about that. He found the very idea of it to be fundamentally unfair. And this wasn't just some clever line, it was the bedrock of his entire philosophy.
So, if all that money wasn't his, then what was it? Well, in his mind, it was a massive pile of claim checks. Like vouchers, vouchers that can be traded for the real stuff that makes the world go round. Human labor, raw materials, energy. And he felt this profound, almost crushing responsibility to decide who got to cash those checks in. And that right there, that brings us to the real puzzle, the paradox at the heart of it all. If this huge fortune was meant for society, why was he so famously, almost absurdly frugal? To the point of making his own daughter pay him back for $20 in parking. It's that contradiction that we're going to unravel today.
So, here's how we're going to tackle this. We'll look at the paradox itself, then his really unique take on inheritance for his kids. After that, we'll get into his surprising approach to philanthropy, his view of society's resources, and finally, his grand plan for all that money in the end. All right, first up, let's really get our heads around this idea of claim checks. This is the big concept, the one that if you get it, everything else he did starts to make a strange kind of sense. See, for Buffett, having $1 billion didn't mean you had the right to just go on a wild spending spree. It was a heavy, heavy responsibility. Cashing in one of those claim checks for, say, a private jet meant you were taking real resources, the steel, the fuel, the work of the pilots and engineers, away from something else society could be using. It was a trade-off he took incredibly seriously.
So how does a man with that philosophy raise his own kids? Well, he was absolutely determined that his children would not become members of what he called the Lucky Sperm Club, just living off those privately funded food stamps. And believe me, he went to some pretty extreme lengths to make sure that didn't happen.
I mean, just listen to this story about his daughter Susie. She's pregnant with her second kid, living in a house that needs work, and she asks her father, the billionaire, for a $30,000 loan. Not a gift, a loan with interest, just to build a decent kitchen. This is a practical need for a growing family, right?
And his response? It was just cold, hard logic. Go to a bank like everyone else. He actually said it was like a star quarterback not being able to just hand his job over to his son. For him, it was about fairness. But can you imagine? For her, it must have felt like a total rejection. It wasn't about being cheap. It was about protecting her from the very thing he hated most, dynastic wealth.
And it wasn't just Susie. His son Howie, he bought a farm with his dad's help, but to Warren it was just another asset on the books. All Howie wanted was for his dad to come out, see the corn, maybe give him a pat on the back, show some fatherly pride. Instead, Warren would just ask him, "Where's the rent check?" It was always business, never family.
His son Peter summed it up perfectly. He said he likes to have strings attached. Even the Christmas presents, $10,000 in stock every year. They weren't just gifts. They were a lesson, a test. Were you going to be patient and let it grow, or were you going to cash it in right away? Everything was a lesson.
Okay, so he's tough on his kids, all to stop them from becoming lazy heirs. So you'd think, all right, this guy must be pouring money into charity, right? Well, not exactly. His approach to philanthropy was, you guessed it, just as unconventional.
Let's rewind the clock to 1979. At this point, Buffett is already worth around $150 million. I mean, back then, that was an astronomical sum of money.
And that same year, his foundation gave away less than $40,000. It's like a rounding error. His friends couldn't understand it. He wasn't spending it on himself, so where was all this money going?
And here's the kicker. The reason is he treated charity exactly like he treated investing. He wasn't interested in just sprinkling a little money here and there. He was hunting for a home run. He was looking for the philanthropic version of Coca-Cola, one single, brilliant investment that could change the world and deliver a massive social return.
And this hunt for a home run led him to these two huge, almost abstract ideas: preventing nuclear war and population control. He was focused on massive, global, future-oriented problems, and the consequence of that? Almost none of his fortune was being used to help people with problems right here, right now, like hunger, poverty, or disease.
All right, so this whole claim check thing, it wasn't just about his family or charity. It bled into his politics. And believe me, for a billionaire, his views were, well, they were pretty radical.
I mean, listen to this. This is a billionaire talking. He's saying, sure, I'll fly my private jet, but when I do that, I am actively taking resources away from the rest of society. And his solution? He's not apologizing, he's demanding to be taxed more for it. He truly believed that personal luxury should come with a very steep social price tag.
And it wasn't just about jets and fancy cars. He was a fierce supporter of a massive inheritance tax. Why? To break that whole cycle. To stop the creation of a privately funded food stamp society that he hated so much. For him, the most efficient way to give those claim checks back to the public was through taxes.
Okay, so let's pull all these threads together now. The hard-nosed father, the reluctant philanthropist, the radical taxpayer. How does this all come together in the end, in the final accounting?
This number right here, tells you almost everything you need to know. For more than a quarter of a century, as his personal fortune exploded into the tens of billions, Warren Buffett sold exactly zero shares of his own company.
So why? Why not cash in just a little? Well, for him, holding on to that money wasn't about being greedy. It was a duty. He was obsessed with the magic of compound interest. Giving away $1 today, in his mind, meant robbing society of the $10 or $20 or $100 it could become in the future. He was playing the longest game imaginable.
So it's not like he was blind to the problems of his own time. He was just convinced, absolutely convinced, that he could make a much bigger dent in the problems of tomorrow. The grand plan, the whole time, was to let that fortune compound into an unimaginable pile, and then, only after he was gone, give the entire stack of claim checks away to be solved by the next generation.
And that's really what it all boils down to, isn't it? The final question he leaves for all of us. Was Warren Buffett a rational genius who made the most calculated long-term bet on the future of humanity? Or was he, as one of his friends once suggested, just a man who couldn't stop the obsessive game of heaping and piling, no matter the cost to his own family or to the very real problems of his own time? That right there is the billionaire's paradox.
You know, we all think of Warren Buffett as this unflappable, incredibly patient investor, right? He's the guy who famously tells us to be greedy when others are fearful. But what happens when the Oracle of Omaha himself gets, well, antsy? When he feels this immense pressure to do something with his money, even when there's nothing really good to do? This isn't just a story about finance. It's really a psychological drama about a strange fear that can get its hooks into even the greatest investors out there.
And that condition, it actually has a name, rhinophobia. It's defined as an investor's disease, basically the dread of ever having any cash. Now, I know it sounds kind of like a joke, but trust me, it's a very real and a very dangerous compulsion. It's that nagging feeling that the cash sitting in your account is just lazy. It's a wasted opportunity, an asset that isn't working for you. And as we're about to see, this disease can push you into making some pretty questionable decisions.
So that really brings us to the heart of what we're talking about today. What happens when the world's most disciplined investor gets a bad case of rhinophobia? This is the story of how Warren Buffett navigated one of the most speculative, crazy bubbles in modern history, fighting not just the market, but also his own internal pressure to invest.
Okay, so to really understand Buffett's struggle here, you've got to put yourself in his shoes. Imagine this massive pile of cash just growing and growing. For an investor, it's like having a loaded weapon with no target in sight. It just sits there and it starts to feel more like a burden than an asset, especially when it seems like everyone around you is making an absolute fortune.
And what's so fascinating is that Buffett, he admitted it himself. He called it an itch to do things. This quote is so important because it just shows that nobody is immune. Even the master of patience feels that exact same impulse that we all do, that compulsion to act, sometimes just for the sake of acting. It's this confession that makes this whole story so incredibly human and relatable.
All right, to really get a feel for Buffett's dilemma, we have to set the scene. Let's hop in the time machine and go back to the late 1980s. Wall Street was in an absolute frenzy, totally consumed by what you can only describe as a leveraged buyout fever.
The crash of '87? That was ancient history in their minds. Greed was back, and it was back in a big way. The game was pretty simple. Take a company, swap its equity for a giant mountain of debt, and poof. Thanks to the U.S. tax code, it was suddenly worth more on paper. They called them leveraged buyouts, or LBOs, and the investment banks weren't just arranging these deals. They were throwing their own money in to get a piece of the action. The market was absolutely red hot.
And if you need one number, just one number to capture the pure madness of that era, here it is, $25 billion. That was the price tag in the bidding war for RJR Nabisco, the company that makes everything from Winston cigarettes to Oreo cookies. The price was so insane it became the symbol of a market that had just completely lost its grip on reality.
Now, Buffett understood the business perfectly. When someone asked him about RJR Nabisco's economics, this was his legendary reply. He knew it was a fantastic business, incredible brand loyalty, but even he was just floored by the price. He saw the quality of the company, but he was completely repulsed by the speculative mania that was driving that bidding war. He ended up passing, partly because he didn't want his name attached to tobacco, but he watched the chaos from the sidelines.
So, you might be asking, how in the world were these massive, logic-defying deals getting financed? Well, the answer was a little piece of financial engineering that Buffett brilliantly called funny money, the zero-coupon bond. Basically, this thing let buyers borrow insane amounts of cash and not pay a single dime in interest for years. It was a way to just kick the can down the road, to make a deal work on paper, even if it was fundamentally broken.
And this just perfectly nails Buffett's critique. With that devastatingly simple logic, he just sliced right through all the Wall Street jargon. By promising to pay nothing for years, companies could take on just absurd amounts of debt with no immediate consequences. It created this huge moral hazard, and it encouraged a level of recklessness that Wall Street had really never seen before.
So with the market on fire and deals being cooked up with funny money, what was Buffett supposed to do? He's sitting on a mountain of cash, and that rhinophobia, that itch to invest, it was getting stronger and stronger. And this led him to a series of deals that were, well, very un-Buffett-like, and they ended up sparking a pretty big controversy.
He ended up putting about $1.3 billion into companies like US Air and Champion International. Now, these were not the fantastic capital-light businesses he was famous for. No, these were capital-intensive, cash-sucking machines. And he even admitted it. He said that he was only buying them because he couldn't find any more great businesses like Coca-Cola at a reasonable price. His rhinophobia was pushing him into his B-list ideas.
Now, these deals were structured in a special way. Convertible preferred stock that you or I couldn't buy. And this is where the controversy just exploded. Wall Street started accusing him of taking white mail. They said he was getting a sweetheart dividend in exchange for basically acting as a bodyguard for the company's CEO, protecting them from hostile takeovers. Buffett's defense was, hey, having a stable, long-term shareholder like Berkshire is good for everybody. But that accusation stuck. Was Buffett helping CEOs keep their jobs at the expense of other shareholders?
For a little while, that debate just raged on. But then, as it always does, the market delivered the final verdict. The era of debt-fueled madness came to a sudden, screeching halt, and Buffett's earlier caution, it was about to be spectacularly proven right.
The collapse was just swift and brutal. It all started in October '89, when a huge LBO for United Airlines just fell apart. The market tanked. Then Drexel Burnham, the very firm that built the junk bond empire, went bankrupt. All of a sudden, that funny money wasn't so funny anymore. The whole system just seized up. The party was officially over.
But here is the absolute masterstroke. Just 2 weeks before that crash, Buffett did something incredible. He used the market's own mania against it. He sold Berkshire Hathaway's own zero-coupon bonds. Investors were so convinced that Berkshire stock would only go up, they accepted a tiny little interest rate. So in effect, Buffett was making a bet that his own overvalued stock was probably due for a fall, and he was using the very financial weapon he hated to do it. Just brilliant.
Okay, so this is the crucial moment. While all of Wall Street is in a full-blown hair-on-fire panic, selling everything that isn't nailed down, what was Buffett doing? Well, he had resisted the worst of his rhinophobia. He had kept his powder dry, and now he calmly went shopping with that giant pile of cash. And then he made two moves that were just stunningly contrarian. First, he bought $440 million of the very same RJR Nabisco junk bonds that everyone else was dumping. He figured that while the price was based on panic, the actual business of selling cookies and cigarettes was still rock solid. Then, in the middle of a collapsing real estate market, he plowed $290 million into Wells Fargo, a bank everyone else was sure was going bankrupt. He was literally buying fear.
And just look at the situation at Wells Fargo. I mean, in 1 year, its quarterly earnings per share just collapsed, from over $4 to just 21 cents. Wall Street was absolutely convinced it was going under. And what was Buffett's response? He went to the regulators and asked for permission to double his stake. That is the ultimate example of being greedy when others are fearful.
So what is the ultimate lesson from this incredible story? Well, it's a masterclass in investor psychology, it's about discipline, and it's about the critical importance of mastering your own inner demons, especially that dread of holding cash. So let's just break down the key takeaways here. Cash, it feels like a burden in a booming market, but resisting that itch to put it to work is one of the most important disciplines an investor can ever have. Why? Because when the panic hits, that cash transforms. It becomes your single greatest weapon. It lets you make incredible decisions, like the Wells Fargo investment, and it helps you avoid poor decisions, like his investment in US Air, which, really, was driven purely by that feeling that he had to do something.
And I think this quote just says it all. Buffett took full responsibility for his mistake with US Air, an airline he knew was a terrible business. He called it an unforced error. See, the error wasn't a bad calculation of the numbers. It was succumbing to the psychological pressure of rhinophobia. It's such a powerful reminder that the biggest risks we face often come from within us.
So that leaves us with a final thought. We live in a world that is constantly screaming at us to act now, to buy, to sell, to never ever get left behind. This story shows that the real challenge isn't just navigating the markets, it's navigating our own psychology. So the question for you is, how do you manage your own itch to act? How do you master your own rhinophobia? All right, let's get into this. This is a classic story, really. It's all about power, about pride, and of course, the inevitable fall from grace. And it all centers on one of the biggest figures in the history of finance. So get this. This quote is where our story really kicks off, and the timing is just incredible. It's the spring of 1991. Warren Buffett, who happens to be Salomon's biggest shareholder, gets up and says this. Just a handful of months later, that extremely good operation is hanging on by a thread, about to completely implode. And that's really the heart of it. We're going to break down how John Gutfriend built this absolute empire, but also how the very culture he championed planted the seeds for its own destruction. And it all comes down to one critical moment, a fatal delay in judgment that brought the whole kingdom crashing down.
But look, to really get the fall, you first have to understand the rise. Salomon Brothers wasn't some blue blood firm born with a silver spoon. No, it was forged in a totally different kind of fire. You know, Solomon started out in 1910 as the ultimate underdog. They weren't part of the old money club. They were scrappy, they were tough, and they were willing to risk their own skin, their own money. They carved out this powerful niche for themselves by becoming a go-to dealer for the US government. They were brash, and that attitude, well, it helped them muscle their way right to the top.
Now, this right here, this was the firm's DNA. Back in '58, Billy Solomon makes this brilliant move. He basically forces every partner to keep their money in the firm. This wasn't just some financial rule, you know? It created this all-for-one, one-for-all mentality. Their fates were literally tied together. If the firm won, they all won, big. And that ethos, it became the engine for their incredible growth.
And into this world walks our guy, John Gutfriend. He was not your typical Wall Street shark. I mean, he was an English major, thought about becoming a teacher. But on that trading floor, he built this persona, this tough, cigar-chomping, crude shell. Some said it was to hide a shyer, more intellectual guy underneath. But whatever it was, it worked. He became the ultimate trader's trader, a guy who people both feared and would follow anywhere.
So Gutfriend takes the firm to heights nobody thought possible. But you know how these stories go. The very moves that made him king also created the first cracks in his empire's foundation. They sowed the seeds of what was to come.
So here's the play-by-play. 78, Gutfriend gets the top job. 3 years later, he agrees to sell the private partnership to a public company. This floods them with cash, just massive access to capital. By the mid-'80s, he's kicked out the old guys and is in complete control. Businessweek literally anoints him the king of Wall Street. But that sale back in '81, that changed everything.
And that sale, it just ripped the firm's culture in two. I mean, look at this. The partnership era was all about shared risk. Everyone's money was on the line together. The public era, though, it became all about me, all about the individual bonus. The focus went from the health of the firm to the size of your paycheck. Like Billy Solomon himself said, the new guys had no stake in it. They basically sold the soul of the company.
And you know, the crazy part is, the same magazine that crowned him king issued this chilling prophecy. With that old partnership spirit gone, loyalty was now just tied to the money. If the profits ever dried up, the infighting would get absolutely brutal. The long knives, as they said, were already being sharpened. And the signs of rot were just everywhere. Gutfriend, the leader everyone feared, was losing his grip. The firm was a mess. It was bloated, running without basic things like budgets or even a chief financial officer for years. He couldn't get a handle on the bonus culture, which just fueled all this ugly infighting. He even told an outsider, Warren Buffett, that he trusted him more than his own people. The kingdom was becoming completely ungovernable.
Okay, so this is where the story shifts gears. We're moving from a slow-motion decline into a full-blown five-alarm crisis, and all it took was one ambitious guy in a position of trust to light the fuse.
So to really get the crime, you gotta understand the arena. The US Treasury market is the biggest, most important market in the world, and Solomon was their primary dealer. That's a position of immense trust. There was one cardinal rule to keep it all fair. Nobody, no single buyer, could snatch up more than 35% of any auction. It was there to stop anyone from cornering the market. But this one trader, Paul Moser, he just starts breaking the rules. First, he finds a loophole and exploits it. The Treasury tells him to knock it off, and he just does it again. Then he crosses a line you just don't cross. He starts submitting these massive, illegal bids using his customers' names without their permission. A straight-up lie to the US government. And when he's about to get caught, he lies to his own bosses to cover his tracks.
And this timeline is the whole story. April 29th, John Gutfriend, the king of Wall Street, is told that his firm submitted a criminal bid to the United States Treasury. So what does he do? Nothing. He hesitates. Maybe that tough guy persona that worked so well on the trading floor was completely useless in the boardroom. Faced with a crisis that demanded immediate, ethical leadership, he froze. Moser stays in his job, and a month later, he manipulates another auction. That delay, that single moment of indecision from the king, it was fatal. So when the truth finally comes out, and not just about the illegal bids, but about the fact that management knew and did nothing, the fallout was swift, and it was absolutely merciless.
The reaction was instantaneous. The market runs on one thing, confidence. And in a matter of days, all confidence in Solomon's leadership just evaporated. The stock went into an absolute freefall, wiping out billions of dollars in value just like that.
It was a full-blown meltdown.
One domino fell right after the other. Major customers started fleeing, lenders got spooked and backed away. The firm's lifeblood, the short-term cash it needed just to open its doors every day, was drying up. And then came the ultimate threat. The New York Fed might revoke their license. For Solomon, that was a death sentence.
So, with the kingdom on fire and his own reputation shredded, the king had one last card to play. He had to make a phone call to the one person he actually trusted.
I mean, just picture this. It is 6:30 in the morning. John Gutfriend, the feared king of Wall Street, calls up his biggest investor and basically says, it's over. He'd seen his own face on the front page of the New York Times and knew his career was done. It's just a stunning moment of total surrender.
Now, Buffett does not want to do this. This is exactly the kind of public mess he spent his life avoiding. But with $700 million of his own money on the line, and more than that, his own reputation, he knows he has to step in. He gets on his plane, which is ironically named the Indefensible, and he flies to New York to take control of the chaos.
And this was Gutfriend's farewell. No real sorrow, no remorse. Just that one last flash of defiance. A line so blunt, so him, it perfectly captures his character. The very thing that made him powerful on the trading floor, that inability to show weakness, was what ultimately destroyed him in the CEO's office.
And talk about a 180. Buffett steps in and immediately lays down a new law. Gutfriend's culture was about pushing the limits, about dominating. Buffett's message was the exact opposite. We're not even going to get near the line. It was a complete rejection of the old kingdom and the start of something new, built on absolute integrity.
And that's really the question this whole story leaves you with, isn't it? John Gutfriend didn't lose his crown just because of one trader's crime. He lost it because he, the guy in charge, hesitated when integrity demanded he act. It makes you ask yourself, in any high-stakes game, what is the real cost of looking the other way, even for a second?
You know, back in 1991, Warren Buffett, an investor famous for his buy-and-hold forever philosophy, found himself in a job he absolutely never wanted. Crisis manager. For 9 incredibly tough months, he took the helm at Salomon Brothers, a Wall Street giant that was just teetering on the edge of complete collapse. And look, this wasn't just about saving an investment for him, it was a bare-knuckle fight for the very soul of the firm, with the stability of the entire financial system hanging right there in the balance. And this right here, this single sentence, which he would later say right to Congress, this became his mantra, his battle cry. It was the principle that would guide every single decision he was about to make. Forget the profits, forget the stock price. For Buffett, this was about one thing, and one thing only: reputation. Okay, so picture this. It's August 1991. Salomon Brothers is the undisputed king of Wall Street. They are the masters of the bond market, but, behind the curtain, something was rotten. Turns out the firm had been caught making illegal bids in U.S. Treasury auctions. Basically, they were cheating the system to corner the market. And that one act of arrogance, it was about to bring the entire empire crashing down.
And then, boom, it all comes crashing down on a Friday evening. The CEO, John Gutfriend, the guy they called the King of Wall Street from the book Liar's Poker, he's forced to resign. His exit kicks off this just chaotic, frantic weekend with one terrifying question hanging over everyone. Is Salomon Brothers even going to exist come Monday morning?
Now, to really get a handle on just how big this crisis was, you got to look at this number. Salomon's balance sheet was a mind-boggling $150 billion. I mean, we're not talking about some little mom-and-pop shop here. If they went down, it could have set off a catastrophic domino effect through the entire global financial system. The stakes were just astronomical.
And if that wasn't enough, this was the real ticking time bomb. Just to keep the lights on, Salomon had to borrow $50 billion in new cash every single day. Think about that. A constant river of cash, all built on one single thing: confidence. And with the scandal breaking, that confidence was just evaporating by the second.
And just when you think it can't get any worse, boom, the knockout blow lands. On Sunday morning, the U.S. Treasury announces it's banning Salomon from its auctions, the very heart and soul of their business. Just like that, the firm's lifeblood was completely cut off. While the board was meeting in total chaos, lawyers were literally in the next room drafting the bankruptcy papers. The Tokyo markets were just hours from opening. They were out of time.
So, in the middle of all this chaos, the board makes this last-ditch, desperate plea.
for Warren Buffett to step in and take over as chairman. And his closest partner, the famously, let's say, blunt Charlie Munger, he thinks it's just pure insanity. He sees it as a thankless, impossible job, basically playing undertaker for a company that was already dead. For Buffett, saying yes meant putting his own perfect reputation on the line for a firm that was already circling the drain.
But against Munger's advice, Buffett does it. He says yes, he takes the job. And in his very first press conference, he shows everybody why he's the man for the job. A reporter asked him about Liar's Poker, the book that glorified Solomon's whole toxic culture. And Buffett, without missing a beat, he pulls off an absolute masterstroke. He says his job is to make sure there is no second edition. With one witty, humble, and brutally honest line, he starts the impossible task of rewriting Solomon's story.
Okay, so surviving that weekend, that was just the first battle. Now, Buffett found himself in a full-blown multi-front war. He wasn't just scrambling to keep the lights on, he was fighting off furious regulators, outraged politicians, and a public that was absolutely convinced that Solomon was rotten to its very core. And Buffett, he moved with just incredible speed. First, he gave his personal home phone number to his top managers, which was this huge symbol, right? That the buck stopped with him. Then, he went straight to the regulators and promised them complete, unconditional cooperation. And finally, he immediately kicked off a fire sale of assets to build up a massive cash war chest for the fight he knew was coming.
But his core strategy, this was something Wall Street had literally never seen before. He called it radical cooperation. Against the frantic, screaming advice of pretty much every lawyer, Buffett waived attorney-client privilege. What that means is he was basically helping the government build its own case against the company he was trying to save. I mean, this was a massive, unbelievable gamble. A bet that total, painful transparency would earn him a second chance.
Now you have to understand, the political climate at the time was just toxic. Politicians were still reeling from the recent S&L crisis, and they were dying to look tough on Wall Street. This quote you see here from a congressman, this wasn't some private comment, it was a public statement. That's the kind of public rage Buffett was about to walk into for his congressional testimony. So how do you handle that kind of white-hot anger? Well, Buffett did it with two words that no Wall Street chief had ever really uttered before Congress. I'm sorry. No excuses, no deflections, no blaming anyone else, just a direct, stunning apology. You can just imagine the air getting sucked out of the room. In that one moment, he completely changed the entire dynamic of that hearing. And he didn't stop there. He took that idea of public honesty and basically made it the new law of the land at Salomon. He gave every single employee a simple but incredibly powerful ethical test. Before you do anything, he said, just ask yourself this. Would you be okay with it showing up on the front page of your local newspaper? It was just a brilliant, simple standard that replaced all the complex legal jargon with simple human accountability. But here's the thing. Battling Washington, that was only half the fight. Maybe an even tougher war was the one he had to wage inside Solomon's own offices against a culture of greed and excess that was so deep-rooted and that Buffett just found totally repulsive. And it all came down to this fundamental clash of cultures. Buffett, the ultimate champion for shareholders, he believed you get paid for making the owners of the company richer, simple as that. But Solomon's culture was the exact opposite. It was a share-the-wealth system, where star traders felt they were entitled to gigantic bonuses no matter how the firm's actual owners did. For these guys, the shareholders, they were a total afterthought.
So what does Buffett do? He drops a bomb. In a year where profits were actually double what they were the year before, he gets up and publicly announces he's cutting the bonus pool by $110 million. It was a shocking declaration of war. He was sending a crystal clear message. The power at Salomon was shifting away from the traders and back to the owners.
And oh boy, the backlash was immediate and it was severe. Headhunters' phones were just ringing off the hook. In a few months, a third of the entire equity staff was gone. A quarter of the bankers, gone. And the press, who had just been calling him a savior, now started running stories painting him as this out-of-touch cheapskate who was ruining the firm. And really, this quote from one of the bankers who left, it just says it all. To the old guard at Salomon, Buffett's laser focus on shareholder value felt like a personal betrayal. They saw it as him not caring about the people. They just couldn't wrap their heads around the idea that for Buffett, running the company for the benefit of its owners was the whole point.
And don't get me wrong, this internal war, it took a huge personal toll on the man. Buffett was used to loyalty. He built his whole career on it. He was not used to the constant backstabbing, the public attacks, this feeling of betrayal. His partner Charlie Munger, he put it bluntly later on. He said for Buffett, the whole thing was just bloody murder.
So all of this, it's all building to a final showdown. The firm is stable, but morale has completely collapsed. Everything, and I mean everything, came down to one last negotiation with the Justice Department. The survival of Solomon itself, and frankly, the validation of Buffett's entire crazy strategy, it all hung in the balance.
And this is where you see Buffett's incredible gamble really pay off. His strategy of radical cooperation created a nearly impossible problem for the prosecutors. Think about it. If they filed criminal charges against Salomon after the company had bent over backwards to help them build their case, what kind of message does that send to the next company in trouble? It would basically guarantee no one would ever cooperate again. Buffett had brilliantly made the conversation not about Salomon's past crimes, but about his own good faith in the present.
And in the end, it worked. The government blinked. Solomon paid a huge fine, $290 million, but it survived. It avoided the criminal indictment that would have been a death sentence. So what happened to everyone? Well, Paul Moser, the trader who started this whole mess, he served 4 months in prison. John Gutfreund was fined, kicked out of the industry for life, and his friendship with Buffett was over. And Warren Buffett, after 9 long, exhausting months, finally stepped down and went home to Omaha, back to his first love, Berkshire Hathaway.
But you know, this whole incredible story leaves us with this one big lingering question. To save Solomon, Buffett had to tame its wild, risk-taking soul, which was the very thing that made it the king of Wall Street in the first place. So it really makes you wonder, doesn't it? Can you actually reform a culture like that? Can you bring in ethics and accountability without killing the very spirit that drives its success? That, right there, is the complicated legacy of Warren Buffett's trial by fire.
Warren Buffett. When you hear that name, you probably think of a genius investor. And you'd be right, of course. But today, we're going to look at him a little differently, as the conductor of a very special trolley, one that's been on a journey that has defied Wall Street for decades. We're going to figure out how he built this thing, who gets to ride it, and why its final destination is forever.
And this, right here, this is our starting point. This one quote just cuts right to the very heart of his entire philosophy. You see, while everyone else on Wall Street is obsessed with trying to predict the next quarter or the next hot trend, Buffett is playing a completely different game. He's focused on something much more permanent, and that's the key to understanding every single move he makes.
So here's the roadmap for our journey today. First, we're going to crack open his core playbook. Then we'll see how he put it to work, making these incredible contrarian bets when everyone else is running for the hills. We'll uncover the secret insurance engine that fuels his entire empire, figure out what it really means to be a passenger on his trolley, and finally, we'll explore his profound legacy of forever. All right, first up, the Buffett playbook. So, if you're not going to try and forecast the future, what do you do? Well, you need a playbook that's built on a totally different foundation. And to really get Berkshire Hathaway, you have to start with the one core principle that separates Buffett from pretty much everyone else. And boom, here it is. This is the fundamental split. For Buffett, investing is a rational act. You figure out what a business is actually worth, and then you just don't pay more than that. Simple, right? Now, everything else on the right side of the screen, he just calls that speculation. It's really a gamble, a bet that some greater fool will come along and pay you an even crazier price. Now, this isn't just about words. This is the absolute bedrock of his entire empire. Okay, so that's the theory. But how did this philosophy actually translate into action, especially during a pretty chaotic time like the early 1990s? Well, this is where the playbook gets real and really, really profitable. Just look at this shopping list. It's a masterclass. When the Soviet Union fell, everyone panicked, thinking defense spending was dead. So what did Buffett do? He bought General Dynamics on the cheap. When a real estate recession hammered California, Wall Street bailed on Wells Fargo. Buffett bought more. American Express fires its CEO and the market freaks out. Buffett throws in another $1 billion. He was literally buying fear, and in every single case, the underlying value he saw eventually won out, leading to some truly staggering profits. But, and this is a really important but, this whole thing isn't about being a perfect fortune teller. He makes mistakes. A big one was his bet on U.S. Air. The airline industry just turned out to be a total money pit, and even the Oracle of Omaha had to admit he got it wrong, cut his losses, and get out. And here's the crucial point. The logic in both cases was identical. With General Dynamics, he bought a solid business that was facing some temporary pessimism. With US Air, he thought he was doing the exact same thing. The outcome was wildly different, but the process, that disciplined search for value, was exactly the same. It's the consistency of the playbook that matters, not a perfect batting average. Now, you might be wondering, where does he get the billions of dollars to make these massive bets in the first place? Well, that brings us to the real beating heart of Berkshire Hathaway, the part of the empire that's often misunderstood, his incredible insurance engine. The magic word here is float. Think about it like this. You pay your car insurance premium today, but you might not get in an accident for years or maybe ever. In the meantime, the insurance company gets to hold on to your money and the money of millions of other people. That giant pile of cash is the float. And for an investor like Buffett, getting to invest that money for his own gain, well, it's basically the holy grail. It is his ultimate competitive advantage.
And he took this idea and just put it on steroids with something called supercat reinsurance. This is where Berkshire insures other insurance companies against colossal, world-changing disasters. The strategy is just brilliant. First, you collect these huge premiums for this very rare type of coverage, which makes your float even bigger. Then, you invest that float for Berkshire's growth. And you only have to pay out in the extremely rare case that a true supercatastrophe actually happens. It's a high-stakes game for sure, but man, it pours rocket fuel into his investment engine.
And the scale we're talking about here is just breathtaking. By 1995, that float had exploded to $3.6 billion. This wasn't some side hustle. It was the power source for the entire Berkshire enterprise. And believe it or not, he was just getting warmed up. You see, buying Geico wasn't just another deal. It was the final chapter in a 44-year obsession. He fell in love with the company's business model when he was just a student, wrote about it as his favorite stock, owned half of it for years, and when it started to lose its way, he stepped in to get it back on track before finally buying the whole darn thing. It really felt, as one person said, predestined.
So we have the playbook and we have the engine. But what makes Berkshire Hathaway truly unique is its culture. And to understand that, you really need to understand the metaphor of Buffett's trolley. Let's just go back to the very beginning. When Buffett first started buying up shares of this failing old textile mill called Berkshire Hathaway, this was the price per share, $7.60. Just burn that number into your brain for a second. Because just about 3 decades later, by the end of 1995, that same single share was worth over $32,000. I mean, just let that sink in. The journey from that dying mill to a global powerhouse is one of the most incredible stories of value creation in modern history. And this chart says it all. For over 3 decades, his annual return didn't just beat the market, it absolutely crushed it. Let me put it in real terms for you. If you had put 10 grand in the S&P 500 back in 1965, you'd have about $224,000. Not bad at all. But that same 10 grand in Berkshire, it would have been worth nearly $18 million. The difference is just night and day.
Wait, here's what riding the trolley really means. Buffett doesn't see his shareholders as anonymous entries on a spreadsheet. He sees them as partners, as passengers on his trolley. He famously knows the families of a huge percentage of his original investors. For him, a share changing hands isn't a transaction. It's someone getting on or off his trolley. His goal isn't to make Wall Street happy next quarter. It's to build lasting value for the people who are on the ride with him.
And if you need any more proof of his commitment, this is it. In 1996, with the stock flying high at $36,000, he publicly warned people that the price had gotten ahead of the company's real underlying value. I mean, can you imagine another CEO doing that, telling the world, hey, don't pay too much for my stock right now. It's completely unheard of. But for the conductor of the trolley, it was his duty to protect his passengers.
And all of this brings us to our final stop, and maybe the most important idea of all. Buffett's approach isn't just about making money. At its core, it's a philosophy about commitment in a world that seems to have forgotten what that means.
Forever. You know, in a world of exit strategies, quarterly earnings calls, and short-term gains, that word is almost blasphemous. But it is the ultimate expression of his entire philosophy. He isn't buying stocks, he's buying businesses. He's not looking for a quick flip, he's looking for partners to be with, ideally, forever. And I think this is why he resonates so deeply with so many people. In a society where everything feels temporary, our jobs, our teams, even our communities, Buffett stands for permanence.
He turns investments into handshakes, into promises. He's a throwback to an era of conviction and long-term thinking.
So let's just sum up the Buffett difference. He completely ignores fashion and trends. He doesn't get sucked into Wall Street's silly little boxes of growth versus value, because to him, growth is just one part of a company's total value. He has no desire to run businesses. He wants to own great businesses that are run by people he trusts. And above all else, he treats his shareholders like family. He's playing a different game by a different set of rules.
And it all leads to this one final thought. In our world of constant disruption, of short-term thinking and just endless noise, maybe the most radical and most successful strategy of all is to find a good trolley with a conductor you trust and simply have the conviction to stay on for the entire ride.